Good morning and welcome back to docket number 24-1201. Do we have administrative matters before we begin?
Yes, thank you, Chairman Gillette. The company was reviewing Read and U over the weekend, and we found that essentially what we would like to provide is documentation. So we would request to convert Read and U to a late filed exhibit, and I believe that would be LFE 131.
That matches my records, so I'll convert Read and U to late file exhibit 131.
I believe that's all the administrative matters the company has.
Thank you. Any administrative matters from other parties or interveners? All right, seeing none, we'll move into our first panel of the day, the company's cost of capital panel. Attorney Tisler or Attorney Pace, would you like to introduce your witness panel, please?
Yes, thank you. To the panel members, would each of you please state your full names and positions for the record?
Good morning, Mike Pizzilo. I'm a principal analyst in the corporate finance and cash management group of Eversource Energy Service Company.
Good morning. I'm Emily O'Neill. I'm the Assistant Treasurer and Director of Corporate Finance and Cash Management for Eversource Energy Service Company.
Jonathan Callan, Manager of Financial Analysis for Eversource Energy Service Company.
Good morning, Rima Hyder, Vice President for Eversource Energy Services Company.
Good morning, Doug Horton. I'm the Vice President of Distribution Rates and Regulatory Requirements for Eversource Energy Service Company.
Joshua Novak, Vice President of Concentric Energy Advisors, here today on behalf of Eversource.
Jeff Malcolm from NERA on behalf of Eversource.
Thank you. Mr. Horton was previously sworn.
Thank you. If the other witnesses could please raise your right hand, I'll administer the oath, at the conclusion of which, if you could affirm by stating, excuse me, I do. I swear to tell the truth, the whole truth, and nothing but the truth under pains and penalties of perjury. Thank you. Attorney Tisler.
Mr. Novak, as part of your preparation for this docket, did you provide pre-filed direct and rebuttal testimony and exhibits, which were marked as exhibits YGS ROE 1 through YGS ROE 12, and exhibits YGS ROE Rebuttal 1 through YGS ROE Rebuttal 8?
Yes, I did.
Did you also sponsor responses to interrogatories submitted in this proceeding?
Yes, I did.
Do you have any updates or corrections to your pre-filed testimonies or interrogatory responses not previously identified for the record in interrogatory responses?
No, I do not.
Do you adopt your pre-filed testimonies and interrogatory responses as part of your sworn testimony in this proceeding?
Yes.
Dr. Malcolm, as part of your preparation for this docket, did you provide pre-filed direct and rebuttal testimony and exhibits, which were marked as exhibit YGS Risk 1 and exhibit YGS Risk Rebuttal 1?
Yes.
To the panel, did you also sponsor responses to interrogatories submitted in this proceeding? Do you have any updates or corrections to your pre-filed testimonies or interrogatory responses not previously identified for the record in interrogatory responses? Do you adopt your interrogatory responses and Dr. Malcolm, your testimony as your sworn testimony in this proceeding?
Yes.
The panel is available for cross-examination.
Thank you, Attorney Tisler. We'll begin cross this morning by the authority staff. Attorney Fryer, please.
Good morning, commissioners. Good morning, panel. My name is Pat Fryer, one of the attorneys at Pura. Also, I have my colleague Kate Keenan with me, who will have a few questions after I concluded my questions. And with me is authority staff, Guy Novello. So on page 24 of the direct testimony, you indicate that with interest rates at high levels, the utilities are no longer considered a safe haven. Additionally, at pages 12 through 13, you mentioned certain factors that affect the cost of equity for regulated utility companies. And so would you consider the XLU a fair proxy for the utility space?
Just a
I apologize. Yes.
Yeah, so there's a few pieces of the question directly, though, is about whether the XLU is a fair proxy.
Correct.
Yeah, I would say the XLU, it does include some unregulated companies or predominantly unregulated companies, but as a general measure of utility performance, it's not an unreasonable measure. It can give you a pretty good indication.
Have you tracked the performance of the XLU year to date?
No, I have not.
Subject check, would you have any knowledge of that it's up approximately 6.5% year to date?
That's generally consistent with what I've seen when I've looked at the S&P Utilities Index, which I've seen up somewhere in the neighborhood of, I believe, 4 to 5%, which is tracked pretty closely to the S&P 500. But I think, looking at just a narrow window gives you a pretty limited view because you referred to my direct testimony, and I have a chart at approximately the area where you cited, page 17 of my direct testimony, where I look at the S&P 500 and the S&P 500 Utilities Index, which is what I used as my proxy for the utility industry. And going back to June of 2022, there's a difference of where we see the S&P 500 increase about 40%. The S&P Utilities Index has only increased about 10%. So if we update that, this was only through the end of September. If we update that graph through the end of May, it hasn't caught up. The S&P 500 is up 45%, and the S&P Utilities Index is actually in about the same place as it was here. It's up about 10%.
But you still agree that the XLU is a fair proxy for the utility space?
I think it gives you roughly comparable results to the S&P 500 Utilities Index. I prefer that index, but they give you roughly the same results.
On a year-to-date basis, in relative terms, does the XLU outperform the overall market?
I don't know.
I'd refer you to page 42 of the pre-filed testimony, and the topic area is bond risk premium. And is an underlying assumption of the bond risk premium that investors consider bonds as an alternative to common stocks?
Investors consider a wide variety of options as alternative to stocks. It could be bonds, it could be other investment vehicles. Investors consider a wide variety of options. Bonds are one of many.
Is another assumption in the risk premium model that the equity risk premium is constant over time?
No, my bond yield plus risk premium analysis looks at the relationship between interest rates and the risk premium over time and shows that there is an inverse relationship between the risk premium and interest rates.
So is the equity risk, has the equity risk premium been constant over time? Are you saying you disagree with that, or?
Yeah, I disagree that the equity risk premium has been constant over time.
How do you choose the period of time that you use in your risk premium analysis?
I've gone back to 1992, which is when I was able to get regular bond data and authorized return data to look at a long-term perspective and a variety of interest rate environments and authorized returns over a broad period. So I selected a period of more than 35 years to look at that relationship.
So I understand that you wanted a historical period of time to look at, but is there a specific reason why 1992, that year, was picked?
Because that's when I could get consistent data for both authorized returns and interest rates.
And can there be a subjective component to the timeframes used in this type of analysis?
I suppose there could be, but my objective was to look at a variety of periods, economic cycles, different interest rate environments, because I think it's important in a relatively short period of time, we've seen not only record low interest rates, but pretty substantial increases. So in my view, it's important to get a broad cross-section of interest rate environments in conducting that analysis.
Referencing RRU 168, as well as the application to issue long-term debt in 250131, I just have some generalized questions. I don't think you need to refer to the RRU 168, but has the company issued any of the debt in that docket? Could the company provide an updated forecasted interest rate on the proposed issuance?
I can tell you approximately where rates would be if we priced today. Is that what you're asking?
That'll be good.
The company has not yet decided on the maturity, the term of the new issuance, but I'll give you rates across the board if that's helpful.
Okay.
Okay. A 10-year rate would be approximately 5.55%. And a 30-year rate would be approximately 6.28%.
Thank you.
You're welcome.
With respect to those figures, would you be able to tell me the spread?
Yield to 1.35%. Approximately. Treasury is approximately 4.88%. Spread is approximately.
Miss O'Neill, if we can just make sure the mic is on and pointed, sorry. Thank you.
You're welcome.
Thank you. Moving back to the direct testimony, I see that Value Line, Yahoo, and Zacks were used. But on rebuttal, the growth rates for Value Line, Zacks, and Cap IQ were used. So I'm just curious why Yahoo was omitted, or I'm assuming Yahoo was omitted. Is that correct?
Yes, you're referring to my discounted cash flow analysis, correct?
Yes, sorry.
Yes, yes. In my direct testimony, I relied on three sources of earnings per share growth rates, two consensus estimates sources, Zacks, Yahoo Finance, and I also looked at Value Line. In October or November, I can't recall exactly when, Yahoo Finance stopped publishing the information. They had previously relied on First Call and IBIS as their underlying source of growth rates. And this has been a source that, for example, FERC has long expressed a preference for using. But Yahoo stopped publishing it. It's no longer available as a free source. It requires a pretty substantial subscription service to maintain getting that data. I don't subscribe to IBIS to get that data from IBIS. I do subscribe to S&P Capital IQ. S&P Capital IQ also produces a consensus estimate. So at that point in time, when it was no longer available from Yahoo, I looked to the nearest best alternative I had available to me, which is S&P Capital IQ. So I've used that going forward. But it is, much like the Yahoo Finance, a source of consensus estimates.
And referring to YGS ROE 4,
Yes, I'm there.
there's just curious how you address the NA column. Are you including, is that the average with a 0 and factored into the average? Or I'm just confused of how you address that. I think there's two spots where there's an NA.
The two NAs. I can't say for certain, but I'm not sure that they're 0. They were not available. I would have to check that relative to the source if you could give me a moment. But either way, for the purpose of this question, if it were a 0 or if it were not available, I would simply exclude that data point. A 0% makes no economic sense. The DCF model requires a positive earnings growth estimate. So it would be excluded from this analysis.
So next, in reference to Schedule D 5.0 and Interrog RRU 137.
I'm sorry, that was RRU 137?
Correct.
Don't have that one in front of me. I don't believe I was responsible for.
I think with RRU 137, we have witnesses Peruta, Shelness, and Murray. And maybe we can ask Mr. Fryer to proceed with the question. I do have revenue requirements representatives here in the audience that we can see if we can respond to it.
I was just going to suggest if I just ask the question, we can see where we go from there. So the beginning balance in D5 is 1.397 billion. On line F14, then adjustments for earnings, capital contributions, and reduction of common stock dividends gives the ending balance. So per the response in RU 137, the entirety of the goodwill balance is reflected in a proprietary capital of 1.375 billion. So would like to know or some information to demonstrate where the goodwill is subtracted for the beginning balance of 1.397 billion on Schedule D5.
I think we'll just need a moment to confer.
Okay, thank you.
Schedule D 5.0 does not include the goodwill. That's already netted out. So the response to RRU 137 is referring to the balance as of December 2023. That, I don't have the number in front of me, but it was 1.37 billion approximately. That did have it, but here 1.397 billion at the start of October, I'm sorry, as of October 2025 already excludes the goodwill. But we can certainly provide an exhibit that shows the exclusion of it.
Yeah, please.
Okay, sure.
Slate File Exhibit 132.
And with that, I have no further questions.
Morning, my name's Kate Keenan. I'm a Pura staff attorney. My first question is, does Eversource or the company receive reports from investor firms or analysts who track Eversource, such as from UBS, Bank of America, or Goldman Sachs? Yes, we do. And do these investor firms regularly issue reports regarding Eversource? For the most part, yes. They will issue periodically, depends on how closely they're following. But within these firms, I think what you're referring to is the sell-side analysts who do publish research on the company. Okay, how frequently do they? It varies, some can be monthly or quarterly. And does the company receive the reports? We do, yes. We're entitled to receive them because they're writing about us. Thank you. Are you aware of any recent reports that have been issued by investor firms or analysts regarding Eversource? Yes, just within the last week or so. Okay. I'd like to request that the company submit as a late filed exhibit any reports, notes, or other documents about Eversource that investor firms or analysts have issued or provided to either Eversource or the company in the last 30 days preceding today? We can do that. We just have to get permission from the firms before we submit them to you. Great, thank you. And that was my last question.
That's Slate File Exhibit 133. Nothing further from authority staff. Thank you. Then let me call up EOE, please. Thank you. OCC. The Attorney General. Commissioner Karen.
No questions.
I also do not have any questions. Does the company need a moment to consider redirect?
I would like a short recess just to speak with the panel outside if I could, please.
Sure, we will stand
Thank
in
you.
recess. Attorney Pace, please.
Chairman, thank you for the chance to consult, and the good news is I have no questions for the panel on redirect.
Thank you. Then thank the panel, and the panel is excused, and we will transition into the panel on page 19, the Office of Consumer Counsel's Cost of Capital, and I believe the company is up first for cross-examination. Good morning. If you'd like to introduce your witness, please.
Good morning, Chairman and Commissioner Karen. This is Dr. Woolridge, the Office of Consumer Counsel's consultant on cost of capital in this case.
Thank you. And Dr. Woolridge, if you could please raise your right hand, I'll administer the oath. I swear to tell the truth, the whole truth, and nothing but the truth under pains and penalties of perjury. Thank you, sir. Attorney Wheel.
Dr. Woolridge, did you sponsor pre-filed testimony and rebuttal testimony in this proceeding?
I did.
Did you also sponsor interrogatory responses in this proceeding? Do you have any corrections or additions to any of those filings?
A couple edits to my direct testimony. People that's kind of repeated. I've handed out a piece of paper, I think, details these. Should I go through them individually or?
Sure. If it would, I did share those pieces of paper with the company. I haven't shared them with the commission. If it'd be helpful, I could read through them and ask if you confirm. Okay. On page 7, line 4, should the word above say below?
Yeah.
On page 26, line 9, should the figure 46.0% be 46.82%?
Yeah.
On page 26, line 9, should the figure 54.0% be 53.18%?
Yes.
On page 27, line 6, should the figure 43.4% be 42.6%?
Yes.
And then page 32, line 16, the same 43.4% should be 42.6%.
Yes.
And it's the same also true on page 33, line 9, 43.4% should be 42.6%.
Yes.
Do you have any additional changes or additions to any of your other filings?
No,
And with those changes, do you adopt these filings as part of your sworn testimony today?
I do.
With that, the witness is ready for cross-examination.
Thank you. And we'll turn first to the company, please.
Thank you. Good morning, Dr. Woolridge.
Good morning.
My name is Rob Hum. I represent Yankee Gas Services Company, and I'm going to ask you some questions today. How are you
Okay.
doing? So do you recall that you provided testimony in the previous rate case for Yankee Gas and docket number 18-05-10?
No, I don't. I mean, I remember the case because but I don't remember all the details.
Sure, but I guess generally, did you submit testimony in that case?
I did.
Do you recall what you recommended for a return on equity in that case?
I do not.
If I were to tell you from page 5 of your direct testimony in docket number 18-05-10, you recommended an ROE for Yankee Gas of 8.75%. Fair to say?
I believe that.
And the ROE that you're recommending in this case is 9.3375% if Pura adopts your proposed 52.13% equity ratio, correct?
Yes.
And as a general matter, do capital market conditions impact the return on equity that's required for a gas utility to attract capital?
Yes.
So given that you're recommending a higher ROE in this case than you did back in 2018, am I correct that your opinion is that there have been some significant changes in the financial markets since 2018 affecting the cost of capital for gas utilities?
That's obvious. I mean, obviously, we had the COVID, we had historically low rates, and rates have come back up. But yes, I mean, the capital market conditions have a big impact on the cost of equity.
Thank you. And do you agree that interest rates are substantially higher now than they were in 2018?
Yes, they are.
And do you agree that long-term interest rates generally have increased in the recent months?
They have increased since, yes, they have. Since I filed my testimony, yes, they were. The 30-year treasury is about 4.5% when I filed my testimony. It's between 4.9 and 5% now. So it's gone up 40, 50 basis points.
And in fact, if you can please turn to your direct testimony at page 59.
Did you say 59?
59, correct?
Yes.
And as you just mentioned a moment ago, that's where you note that the most recent 30-year treasury yield that's in your testimony is that 4.50%. And that's what you apply in your CAPM, correct?
That is correct.
Do you agree that granting an authorized ROE that is far below the return expectations of equity investors could result in adverse consequences, such as further credit downgrades and increases in borrowing costs for Yankee Gas?
I believe it could, yes.
Now, is it correct that you use dividend per share, book value per share, and retention growth rate measures as part of your discounted cash flow model?
Yes.
And Mr. Novak suggests that emphasizing these growth measures in your analysis is one of the reasons that your recommended ROE is significantly lower than his recommendation, correct?
Well, I mean, certainly, and obviously I look at alternative growth measures because, the fact that the academic research has shown for decades that the projected 3 to 5 year growth rates of analysts are overly optimistic, upwardly biased. So, I mean, I look at alternative more than I know we disagree on this item, but yes, I look at alternative measures of growth and not just analyst growth rate forecasts.
Thank you. And to try to sum that up, do you agree that the emphasis on these factors is a driver of the difference between your DCF model and Mr. Novak's DCF model?
Oh, yes, I agree.
And if you can please turn to Exhibit JR5 at page 4.
Yes.
Now, this summarizes your projected growth rates from value line for EPS, DPS, BVPS, and sustainable growth, correct?
Yes.
And looking at the first value line estimates for projected EPS, the median result is 6.0% for both of your proxy groups, correct?
That is correct.
Now looking at the other measures, which are DPS, BVPS, and sustainable growth, the mean and median estimates are all within a range of 3.4% to 5.0%, correct?
I agree with that. And I believe that, yes. I mean, I also, with respect to these value line forecasts, I've indicated the earnings forecasts have been shown to be dramatically overly optimistic over the study that I've found that looked at those. So yeah, I do use, and obviously according to the DCF model, all these are supposed to move together. So that's another reason why I use it. But those are the two reasons I include alternative measures of growth.
Now turning to exhibit JRW 5 at page 1.
Yes,
And there you selected 6% for your growth rate in the DCF analysis, correct?
yes,
And that's 100 to 260 basis points above the mean and median estimates for DPS, BVPS, and sustainable growth that was included in your DCF analysis, correct?
I'm sorry, could you repeat that, please?
Yeah, so the 6% for your growth rate in the DCF analysis is 100 to 260 basis points above the mean and median estimates for DPS, BVPS, and sustainable growth of 3.4% to 5.0% that you included in your DCF analysis, correct?
Yes, it is. It's somewhat higher. I go through on my explanation of how I got that number, but I just combined more than just analyst growth rates. Yes, I did. And if I hadn't done that, obviously my numbers would look a lot more like the companies.
Now, with respect to the market risk premiums, you rely on various publications and academic studies rather than an analysis of historic stock and bond market returns, correct?
Yeah, as I say, it's the biggest mystery in finance, according to Merton Miller, who is one of the great ones. But yeah, I agree. I look at what alternative sources. There are a lot of sources. Since the market risk premium has been such a mystery, there's a lot of research done on this because the numbers are all out there, whether they use historic returns, you use surveys. So there's a lot of sources and a lot of investment firms publish their estimate of market risk premium. So yeah, those are the sources I used.
And along the lines of what you just described, the publications and academic studies that you reference are based on subjective judgments and opinions of the future rather than observable and verifiable historic market data, correct?
I disagree with that. I would say no. If you look into my sources that I use, like JP Morgan, very detailed, very much kind of how they get to their numbers. So I would say some of these, I mean, obviously, for example, I use, a couple KPMG and others. They detailed explain how they get to their numbers. So, and Kroll does the same thing. They put out a report saying, well, we're at 5% and this is why, these are the numbers we looked at. Yeah. So I mean, I wouldn't say they're just subject. There's a lot of analysis that goes through because obviously if JP Morgan's going to put their name on something, they aren't going to just throw out a number.
And would you agree that subjective judgments and opinions are essentially just prognostications of the future rather than objective data-driven analysis?
Oh yeah, but I mean, but it's based on the objective data that they have, but based on that data and other market factors, they provide their opinion of what it is. And obviously, these investment firms have market risk premiums that are much below a lot of the historic numbers and that sort of thing.
Now, turning to your CAPM analysis, historically, you used to use the beta coefficients from Value Line exclusively, but for this case, you used both Value Line and S&P Capital IQ, and not just Value Line exclusively, correct?
I agree, that's correct. And I discussed that in a fair amount of detail in my testimony at, I discussed in a fair amount of detail in my testimony at, sorry, I would just like to highlight, I mean, I do because primarily, after 2020, 2021, the betas for utilities went from 0.55 to 0.9 or in that vicinity. And when I started looking around at betas, you find the betas from Value Line are based on weekly data and they're based on the New York Stock Exchange Index. Well, if that's your market index, you're excluding the entire tech sector, which doesn't trade on the New York Stock Exchange. So a lot of the volatility in the market. So the average beta of the 1,700 companies covered by Value Line is 1.14. Well, the average beta is supposed to be 1. So it's how using that index artificial inflates it. So I have also used those from S&P Cap IQ. They use monthly data. They use the S&P 500 as a market index, not the New York Stock Exchange, and their betas are lower. Now, I do apply the Bloom adjustment, which I discuss in there. There is one study that's about a decade old, says that they don't apply it in utilities, but I applied it because it's generally been used. But yes, you're correct. And I think I did it before this case. It wasn't just this case that I changed it for, but after doing my analysis of betas. Sorry, that was a little long.
No, and thank you. And I guess I want to break that down just a little bit in terms of what you describe in your testimony with respect to that departure. So your testimony, from my understanding, provides 3 reasons for the departure from exclusively using Value Line, correct?
Yes.
And the first reason is the fact that Value Line uses weekly returns and the volatility of utility stocks during 1 month, and that was March 2020, that impacted the weekly average more than the monthly average, correct?
Yes.
And to be clear, when you're focusing on that 1 month, you're talking about 4 weekly observations out of 260 weekly observations over the past 5 years.
Yes.
Correct? And did Value Line change its reporting timeframes during 2020?
No.
So Value Line has consistently reported betas based on weekly data, correct?
They have. And again, there's more than a Value Line as a source of betas. There's betas all over, Yahoo, others. And Value Line's unique. Value Line and Bloomberg both use weekly data. And again, Value Line uses the New York Stock Exchange. Everybody else uses the S&P 500. So there's a lot of issues about that. But you know, if you look at Yahoo, you look at betas, they're going to use monthly returns. They're going to use 5 years of data, the S&P 500 as a market index, and they're going to report utility betas, which are much lower than what we see it for Value Line. So there's other sources of betas.
Value Line has not changed its methodology.
No, it has not.
So given that the volatility from March of 2020 occurred 5 years ago and is a very small part of the historical observation period, why do you remove or mitigate the impact of the results from the model that you've historically?
Because that's not the only reason I use that. As I say in my testimony, why do I do it? Value Line uses a market index no one else uses. No one else uses it. Their average beta is 1.14. It's not 1.0. It's a tautology that the average beta should be 1.0, but it's because they use a different index. So I would say that, I mean, that's another reason. Obviously, the adjustment factor. So there are other reasons than just the March 2020.
Did you use Value Line beta coefficients exclusively in the 2008 timeframe?
I did.
And the volatility of the market due to the subprime mortgage and housing crisis during the 2007 to 2008 timeframe didn't warrant a departure using Value Line betas, correct?
I don't remember that at all. I mean, I've always talked about some of my reservations against Value Line just because of their market index, just kind of, I'm sure they do it for continuity just because they've always done it that way. You know, they don't want to change suddenly, but it would change significantly their betas because their average beta is 1.14, not 1.0.
So we talked about there being 3 reasons for the departure. The second reason for your departure from using exclusively Value Line beta coefficients is that you note that Value Line betas are computed using the New York Stock Exchange Index, correct?
Yes.
And the New York Stock Exchange is made up of about 3,000 stocks from a wide variety of industries that provide a broad-based market index, correct?
Yes, but it excludes most of the tech companies would continue to stay on the NASDAQ. And that's where more of the volatility is, and as a result, if you had a more volatile market index, I mean, betas for utilities would be lower.
Do investors continue to rely upon Value Line's published beta coefficients?
I don't know.
Do you have any reason to disagree that they would?
No, I don't know why Value Line wouldn't rely on Yahoo's beta coefficients. I mean, there's more than one source of a lot of these things out here, but I know I use Value Line with the reservations I talk about in terms of the market index, the fact that historically their numbers have been overly optimistic on income, on EPS, that sort of thing.
Now, the third reason from your departure from using exclusively Value Line beta coefficients is that you note that most CAPM betas, including Value Line, publish adjustments using the Bloom adjustment, correct?
Yes.
And you state this is an issue with the Value Line betas, correct?
Well, it's just an issue because, again, they assume that the Bloom, now, first of all, the Bloom adjustment was, Marshall Bloom did this, 50 years ago. So it's been around a while. But they have, and again, it's a very 2/3 times the historic beta plus 1/3 to get the fact that betas tend to regress towards 1. But yeah, I mean, it's been around, it's generally accepted. There's been one study that says it shouldn't be applied to the utilities, but I have applied it when I'm using and it's so effectively both the Value Line and my adjusted cap IQ betas are adjusted.
Well, the S&P Capital IQ that you used in addition to Value Line does not include the Bloom adjustment, correct?
No, I had to make that myself. I mean, obviously, they're publishing that for a reason. I mean, Mr. Nowak uses S&P Cap IQ. A lot of people do. And so that's what they say. And Value Line anymore, if you dig into their data, they publish a 3-year beta, a 5-year beta. So they publish different betas, but the one on the sheet's the 5-year beta.
Now, if you can please turn to your direct testimony at page 62.
62?
Correct. Specifically lines 13 and 14.
Okay.
So there you state that you added the Bloom adjustment to the S&P Capital IQ's beta, despite stating that the Bloom adjustment is a reason that you no longer exclusively use Value Line, correct?
No, I mean, it's not. No, as I said, there's multiple reasons why I don't use, why I use an additional one. One being obviously that market index.
Now, the use of the S&P Capital IQ betas as adjusted, in addition to the Value Line betas in your analysis for this proceeding, resulted in lower betas and therefore a lower ROE than if you used Value Line exclusively, consistent with your past practice, correct?
Well, yeah, but I made this adjustment several years ago. It wasn't just for this case. It does, but again, investors are, they could use Value Line, they can use Yahoo. It's not like they're sending one source of data out there. It's Value Line's one source. There's a lot of other sources of data. And Cap IQ is used by both Mr. Nowak, myself, and he doesn't use those betas. He uses the Value Line beta. So yeah, we have differences where there's no one knows if people rely more on one service or another, at least not that I'm aware of.
Thank you. No further questions. Thank you.
Thank you. Authority staff? EOE? EOE has crossed. Okay, thank you.
Hi, Dr. Woolridge. Alex Sahi at EOE. I'm joined here with Tom Lopez at EOE and Aaron Rothschild at RFC Consulting. I just have a few questions for you. On pages 2 to 3 of your direct testimony, you state that Hope and Bluefield established 3 guiding principles that returns comparable to similarly risky investments. There's sufficiency to maintain financial integrity and adequacy to support credit and attract capital. Is that correct?
Yes.
Can you discuss how those principles influenced your testimony overall?
Well, when obviously, I look at the returns that I come up with. I look at the returns that these companies been earning. I look at their market to book ratios, which are well above 1, which tells you they're earning a return that above investors' return requirements. I look at how much capital they're raising to see if they're capital. I'm looking to see if they have, investor, they have, triple B or above investor ratings. So they aren't rated junk, that sort of thing. So those are all evidence in support of the 3 factors or Hope and Bluefield.
Thank you. The list that you just provided, were those all the factors that you used in your testimony in calculating your overall cost of equity? Or are there other?
No, I use the DCF and the CAPM to compute my cost of equity. To assess whether I think it's fair, I look at these factors.
Okay. Did you look at other jurisdictions' authorized ROE as a check on your cost of capital?
It's throughout my testimony, and I detail a lot of different elements of authorized ROEs. I do a study showing the relationship with interest rates, that sort of thing. So yeah, I mean, I look at authorized ROEs. I've in my rebuttal testimony after criticisms of the Werner study that I highlighted the other one that supported the same thing and provided that to show that these things historically have been a little overly optimistic or just above investor return requirements.
Thank you. So I'm just trying to understand. So you use different capital market data and you're also using this check at looking other authorized ROEs. How?
No, I don't use authorized ROEs in anything I do. I present them. But there's nothing that I do and I reflect on the fact that where they are relative to interest rates.
If you only looked at the market data and investor expectations, would your recommended ROE be lower than what is recommended?
No, that's why I looked at I didn't use authorized ROEs for any reason. I mean, other than presenting them to show where I am relative to, I as I say in my testimony directly, I still, even though mine is below the current authorized ROEs, I think given the fact that they've been overstated in the past, mine's consistent with that.
Thank you. All right, moving on. On page 95 of your direct testimony,
Yes.
yeah, starting on line 3, you discussed that gas companies have been selling above book value for the last decade.
Yes.
Can you explain what you mean by this?
Well, I explain it in my testimony. If you read my testimony at pages, I read my testimony at pages generally between pages 36 and 38, I basically explain what happens when you earn a return that above investors required, why the market value goes above the book value, I cite an old case, Harvard case study that talks about that exact relationship.
Okay, thank you. Now, you just had a discussion with Attorney Hum on the term of value line betas, and you said that Value Line does publish 3-year betas, but
They have them elsewhere. I've seen, if you subscribe to their investor analyzer or whatever it is, you kind of have to dig through the data. It's not in their published data, but you dig through the data, somewhere they have 3-year, 5-year, that sort of thing.
okay, and you use the 5-year.
I've used the one that's on the Value Line sheet. And that's a 5-year weekly data, New York Stock Exchange index. And I discuss in detail those things.
Thank you. Have you ever considered using betas of less than 5 years?
I've just used 5 years. I think, the history, obviously that's history, and, things can change. So beta can change, that sort of thing. And there's an adjustment to beta. So there's different opinions on betas. I don't think anybody's come up with, this is the beta that anybody can use.
Okay, thank you. Now, turning to page 27 of your direct testimony.
Yep.
You state that the common equity ratios for the gas and combination proxy groups, and I think I got this right, you changed it, it's 42.6?
42.6, yeah.
Still 41.7%?
Yes.
Okay. And then on page 30, further down in your testimony, you state, as the equity ratio increases, the utilities revenue requirements increase and the rates paid by customers increase. Is that
Yes.
correct? Can you explain what you mean by that?
Well, just if you have more equity, everything else equal, more equity, unless it's offset one way or another, it's going to result in a higher cost of capital, a higher equity ratio.
And then later in your testimony, in your direct, on page 31, you state that one may see equity ratios for gas distribution companies range from 40 to 50%, correct?
Yes. That's just an observation I made.
Okay. And then on page 33, your recommended capital structure includes 52.13% common equity ratio?
Yes.
Okay.
I simply used the average since, I didn't make much of adjustment to it. I just recognized that it's high compared to everybody else. So I just made a slight adjustment. And again, just looking at what other, looking at approved equity ratios. So I made a slight adjustment.
You made a slight adjustment based on what?
That the fact it's high relative to other other gas companies.
Hi, Dr. Woolridge, Tom Lopez on behalf of VOE. I guess a follow-up. I think to put a finer point, an adjustment, you adjusted what was the company's
Proposed,
request?
yes.
Okay, and so looking at other approved capital structures, you made an adjustment based on
Yes.
that? Okay. Was there any other specific analysis
No.
related to that? Okay, thank you.
Was the common equity ratio that you were looking at the utility holding level or the subsidiary level?
That was at both. It depends. Obviously gas companies, most of them are subsidiaries, but some are integrated gas companies.
Okay. And to reach your 52.13, you didn't use the proxy groups, correct?
No, I put the numbers in on page 3 of Exhibit JRW4.
Thank you. I think we're all set. Thank you, Doctor.
Okay, thank-
Thank you. Attorney General? Thank you. Commissioner Karen?
No question.
Also do not have any questions. Does the OCC need a moment to consider redirect?
No, we have no redirect. Thank you.
Thank you. Let's proceed into our cost of capital panel sponsored by the Office of Education Outreach and Enforcement. I believe the OCC is up first for cross-examination. Director Lopez, if you want to introduce your witness.
Thank you, Chairman. Mr. Rothschild, if you would please state your name and position for the record.
My name is Aaron Rothschild. I'm president of Rothschild Financial Consulting.
Thank you. Sorry.
I'm going to minister the oath. Mr. Rothschild, if you could please raise your right hand. I swear to tell the truth, the whole truth, and nothing but the truth under pains and penalties of perjury.
I do.
Thank you. Director Lopez.
Thank you, Mr. Rothschild. As part of your work for this docket, did you provide pre-filed testimony, the rebuttal testimony, and interrogatory responses in this docket?
I did.
Thank you. And do you have any additions or corrections to your testimony or interrogatory responses?
I do not.
Do you adopt all of those items as part of your sworn testimony in this proceeding?
I do.
And thank you. Mr. Rothschild is now open for cross-examination. Thank you.
Thank you. Attorney Wheel, please.
Good morning, Mr. Rothschild. Tom Wheel for OCC.
Good morning.
Your testimony talks about the relationship between the authorized equity ratio and risk. And on page 9, you discuss how a higher common equity ratio presents a lower chance of financial risk. Can you explain that?
Yes, just in general, a company that has lower leverage or lower amount of debt would be lower financial risk. So a higher common equity ratio would mean higher debt or higher leverage. So all else equal, as the common equity ratio increases, the financial risk for the company would decline.
And as the risk for the company declines, would that put upward or downward pressure on the cost of equity?
As the financial risk decline, it would put downward pressure on the cost of equity.
Okay. Your testimony references a regression analysis of dozens of utility companies where you say you found that there's a 4 basis point reduction in ROE for every 100 basis points increase in the common equity ratio. Is that right?
That's right.
And I saw that you provided that analysis in response to YGS EOE 6. Can you explain in simple terms how you found that relationship?
Yeah, it is actually quite simple. It's just a simple regression analysis that I did a long time ago. When we did that analysis was before there were a lot of mergers. So it was a lot easier to do this kind of analysis. We could look at companies there weren't so many utilities at holding company levels with unregulated operations. So we could just take a look directly at utility companies, and we could look at do a regression, varying the capital structure, so say the common equity ratio, and then compare that to a DCF cost of equity result. And we could run a regression analysis, and we could show, as expected, there was a relationship, and that as the common equity ratio increased, you tended to get a lower indicated cost of equity.
Thanks. On page 6 of your testimony, in footnote 3, you note that a higher common equity ratio, all else equal, results in higher rates for consumers because equity is more expensive than debt. Is that a reference generally to the comparative rates of return on equity and debt?
Yes, there would be two driving reasons. I mean, one is just the cost of equity is higher than the cost of debt, so that rate. So if you have a higher percentage at a higher rate, you're gonna get a higher overall rate of return, which leads to higher rates. The other important piece to that is that the equity component has to be grossed up for taxes when rates are being set, where the debt component doesn't. So the capital structure can have a fairly large impact, even larger than it looks initially, because you have to consider that equity rate is going to be grossed up for taxes.
Thanks. So as to the first point of just the difference between the two rates, the cost of equity versus the cost of debt. So for example, as noted throughout your testimony, the company's recommended rate of return on equity in this case is 10.3%. The recommended debt cost is 4.5%. So the difference between those numbers just by themselves, one is 129% higher than the other. Does that sound right? 10.3 and 4.5. Your testimony on page 15 has a table with the company's proposed rates of return on equity and debt, as well as their recommended capital structure, right?
Yeah, so for some reason my computer just decided to slow down here. Yeah, I don't think I have to look, but go ahead. Yeah.
In that table, subject to check, the company's recommended rate of return on equity is 10.3%, but their equity ratio is 53.81%. Wouldn't that result in a weighted cost of equity of 5.54%? You just divide 10.3 by 53.81%.
I'd have to, I wish it would come up.
Yeah, I can take
Let me grab, actually I have the Excel here. That's shown in a table, correct?
I think your table doesn't show the weighted costs, so I'm asking, I think what your table on your testimony shows is the return on equity of 10.3% and the requested equity ratio.
Okay, I see the table 3 shows, I have a 10.8 there though. Is that, you're referring to my table 3?
One moment.
Because I combine the Novak and Malcolm. So there I have a 10.8 because we're combining Novak's 10.3 and Dr. Malcolm's risk premium to get to 10.8. And there I have an overall rate of return, so weighted average cost of capital there of 7.89. Okay. I guess you're asking what would it be if that was 10.3?
Actually, I'm not gonna ask that. I'm gonna ask a slightly different question. I just have to do some math myself first. So one moment. A moment ago, I asked you about the difference between the overall cost of debt of 4.5 and the requested return on equity of 10.3. Yeah. We talked about how the return on the cost of equity was 129% higher than the cost of debt. At 10.8, would that be 140% higher than the cost of debt?
Just doing, it was 10.3 over 4.5.
Yep.
Yeah, I would agree, subject to check. It's not.
Yeah. Okay. So if the overall total recommended return on equity is 10.8% and the ratio is 53.81, then the weighted costs of equity would be 53.81% of 10.8 per, is that correct?
Maybe the best place is to look at, can you ask that question again?
Sure, I'm just trying to get at the overall rate of return on capital.
Yeah.
That's derived by adding the weighted return on equity against the weighted cost of debt. Is that correct?
Yes.
And the weightings are derived by the capital structure, by the proportions of equity and debt?
Exactly.
Ultimately, what I'm asking is, isn't it true that in a capital structure where the proportion of equity outweighs the proportion of debt, such as a capital structure where there's 53.81% equity, doesn't that make the delta, the comparative size of the weighted cost of debt and the weighted cost of equity even larger than the delta we discussed before because of that weighting?
I think I'm seeing what you're saying. I think the main point I want to make, which I agree, is that capital structure can have an extremely large impact, and you also have to account for the fact that it's grossed up for taxes. So I would say yes, when you compared to like a capital structure with 50-50, as you increase that common equity ratio above 50, yes, it's going to really basically amplify, in a sense, what I think is where you're going, that authorized ROE. Yes.
Yes. So in addition to the fact that the cost of equity has to be grossed up for taxes, if the capital structure is more weighted towards equity, it makes the cost of equity even more expensive. Is that correct, as compared to the cost of debt?
Yeah, I think that's an important piece. It really, you have to, the accountants have to do that, but yes, it increases it by quite a bit. Yeah.
Thank you. Your testimony on page 102, I'm not sure if you're able to open it yet, but it discusses the analysis by the company's witness that the spread between BBB and BB credit ratings is 102 basis points. Do you recall that?
Yes.
And do you disagree generally with that analysis?
Well, just the math is pretty simple. So it's not really that I disagree subtracting what those numbers are. It's just how he came to that figure. I really strongly disagree with. I mean,
and well, what is it that you disagree with?
Well, he spent a lot of time talking about his understanding of the history of regulation and so forth, and discussing the kind of the benefits in the United States and so forth. But then he just jumped and talked about this possibility of junk status and just made this subtraction without making any kind of real connection between the two, as I see it. So there was no, that was kind of a key link that I did not see at all.
So did you see a disconnect between the kind of rationale for the general rationale for a regulatory risk premium and then the calculation of the premium itself?
Yeah, they were not interconnected. Yeah.
Okay. Is it your understanding that the rationale, that the calculation was, I think you referenced it a moment ago, but it was somehow based on an expectation of a credit rating differential?
Yeah, there was we looked at the spread, the 102 basis points was between BBB, which is investment grade, and then BB, which is junk. So it's kind of assuming that it's going to be, that's the appropriate spread, that kind of Connecticut is junk. And as I had stated in my testimony, regardless of, if you look through the hundreds and hundreds of pages of what credit reports are saying, they say that the regulatory environment can be credit supportive, and I forget the exact term, but basically it's credit supportive, and that the business risk is strong. So how to get a junk status there, I don't know how. And of course, I discussed and looked at some, since he had opened up this realm into the debt market to, as a proxy for the cost of equity, which isn't perfect, right? There's not a perfect connection. But since he had opened that up, I had presented the evidence regarding comparing of CLNP bonds and showing that there wasn't, that premium was not being found there in terms of what investors are saying in terms of the market yields.
If there were an adjustment to a credit rating resulting in junk bond status, would your expectation be that that would also impact, if not primarily impact, the company's cost of debt?
Yeah, I mean, you would see it in the secondary market trading for debt if investors really agreed with Dr. Maycomb there that they were junk status. You would see it in the yields, and we don't.
Okay. I'm going to put something on the screen, which is Schedule D 3.1 as filed in this case. If you can, thank you, Ms. Lupoli. And by I'm going to put something on the screen, I mean Ms. Lupoli is going to be very helpful and put this on the screen. I'm not sure if you can see that. Have you had a chance to look at this schedule, which is the schedule of the company's overall debt portfolio?
I have seen it. It's been a while, but let me.
Okay. Again, I'm not sure if you're able to see it, but at the bottom line, there's a number there's a label that says the embedded cost of long-term debt. Is it your understanding that that figure is derived using data from all of the debt instruments that are listed on this schedule?
Yes, that's my understanding, is a weighted average cost of those debt instruments, yeah.
Is it your understanding that if the interest rates available to the company were to increase, for instance, in the event of a catastrophic credit downgrade, that the carrying values and annualized costs for all 17 of those instruments would also increase?
They would, it just as long as you're making sure you had the up-to-date information of what the market is saying, because when a bond was initially issued and had a coupon, you'd have to make sure that you were looking at what the market yield was at the right time. But that's why I did my whole analysis in my testimony. I think I'm going along with, yeah, that's why I did the analysis I did in my testimony, to look at the market yields of CLNP over time.
Okay. On page 15 of your testimony, you say page 5, line 15, you say, my cost of debt recommendation is based on the actual cost of debt paid by the utility to its sources of credit. For example, if a utility has issued a bond with a 3% interest rate 3 years ago, its authorized cost of debt should be 3%, even if interest rates are currently higher or lower than 3%. With respect to that hypothetical statement in your testimony, did you mean that the utility's authorized cost of debt with respect to that one hypothetical bond should remain at 3%, even if the current interest rates are higher or lower than 3%?
Yes, it's the way the rate setting works in that regard is it's just a pass through. So if the company issue a bond at an interest rate of 1%, for example, and if a couple of years later interest rates went up, consumers don't have to pay more. They can continue to pay that embedded cost of debt. And so in the other way, if they had issued it when interest rates were high and interest rates had come down, the company's still able to charge rates based on when they issued the debt at that time.
Okay. So if you, not sure again if you can see it on that screen, but if you look at the maturity date column, which is, thank you, Ms. Lupoli, would you accept, subject to check, that all of these dates except for 3, the maturity date ends after October 31st, 2026?
I guess I would agree, subject to check. One looks like July, but I'm not sure.
Okay.
But yes. Yes.
In your opinion, if available interest rates during the rate year, which ends October 2026, are higher than the 14 instruments shown here that won't mature during that rate year, would it make sense for the company to refinance those instruments at a higher cost than their than their original cost of debt, their original interest rate?
No, so even if they had the option to refinance, couldn't imagine a situation you're going to refinance to pay a higher interest rate.
And if Yankee were to issue new debt in the rate period at a higher rate than those reflected on this table, wouldn't that new note just be incremental to the instruments listed here? So its impact on the overall embedded cost of debt would be muted by all of the other instruments on this table?
Yeah, exactly. It would become part of the weighted average, so it might impact it, but only based on a weighted average. Yeah.
Thank you. You mentioned a moment ago that the cost of equity imposes tax that needs to be grossed up for tax. Is it your understanding that that cost, the cost the utility has to pay, the income tax the utility has to pay on its equity return is recoverable from ratepayers?
Yes.
Okay. So in your opinion, should the authority also take that into consideration when weighing potential increases in debt versus potential decreases in equity?
Yes, absolutely. That should come into play. I think that's why it can often we get overly obsessed with ROE, which is certainly important, but capital structure can have a major impact, and there's no reason to charge consumers for a capital structure that has an unreasonably large amount of equity. And that's why I recommend in my testimony strongly looking at the holding company level. And you can see that the common equity ratio used by these companies in our proxy group to actually raise the capital is, I believe, is like 47 or so % common equity ratio. So I haven't seen any evidence about why Yankee Gas would need so much more equity than that.
Thank you. This exhibit will stay on the screen until my next one, but I'm done asking about this exhibit just so if it helps. I want to ask some more general questions about what your recommendations, what it is that PURA is trying to do, or what you recommend PURA does when it's setting the cost of equity in a rate case. On page 25 of your testimony, at line 11, you say the capital market data discussed below indicate that an authorized ROE of 8.19% is sufficient for a regulated utility like Yankee to raise capital from investors. And on page 45, at line 9, you explain the cost of capital is the return investors require to provide capital to Yankee based on current capital markets. To measure the cost of equity accurately, it's critical to use the current market data because it increases the chance that the authorized ROE will match Yankee's market-based cost of equity. It says COE, but I think that's what that means, right?
Yes.
When it needs to raise equity capital. So as a basic concept, is it called the cost of equity because it's the costs that a utility has to pay in order for it to raise equity capital?
Yes, the cost of equity would be the cost in terms of the return that investors demand to provide equity capital. So my orientation in my testimony is to determine what that is, so PURA can make an independent decision. What are investors demanding to provide equity capital? And I believe an 8.19% in this case is very conservative, very reasonable calculation of that figure. So I don't. Does that answer your question in terms of how they relate? Yeah.
Yes, thank you. In your understanding, how does Yankee Gas specifically raise equity capital from investors?
They don't raise it directly. That's done on their behalf from Eversource Energy.
So with respect to Yankee Gas's cost of equity, are the investors from whom it seeks to raise capital its parent company, Eversource Energy? Is that your understanding?
Yes, so that's where the equity would come from. But in terms of my perspective, I look to capital markets in terms of, so when I make these calculations, I just look what are capital markets indicating regarding what kind of returns they demand for investments of different types of risk. So whether Yankee was going directly to the market in that regard, or whether it was or Eversource is doing it, is not as complicated or as big of a deal than when we talk about capital structure.
So in your opinion, is the appropriate measure of the cost of equity the return necessary to convince Eversource to provide equity capital to Yankee?
No, it's a good question. It really should be what to convince investors in general to provide equity capital for to invest in Yankee Gas. So that's the main audience here, or the main or the main measurement here is looking to investors directly.
So in your opinion, should PURA be setting the rate of return on equity as compared to the authorized rates for Eversource's other subsidiaries in other states? Is that the appropriate viewpoint for PURA to take?
No, not at all. That's an unfortunate comparison that's often made. I mean, so imagine if you have in one jurisdiction, for some reason, they decided to provide an authorized ROE that was too high. We could all agree at 20%, right? So, and then it was 8% in another jurisdiction. The argument would be, well, why would we invest at 8 when we can get 20, right? But the main thing we have to look at is what is the actual cost of equity. If the cost of equity is 8, well, you can raise it and invest at and earn at 20, and you can also invest, and investors will be happy to earn 8. So this idea that they're not going to provide when they could earn 8 because they could earn 20 is just fundamentally not true. The idea is investors are going to continue to invest as long as it's equal to or greater than their opportunity cost.
Thank you. Kind of along the same lines, on page 46 of your testimony at line 9, you say, my cost of equity recommendation is based on my computation of what the market indicates investors require, return on investment, to provide capital to companies with comparable risk to Yankee. Couldn't you just ensure that Yankee's return on equity is commensurate with returns for other companies with corresponding risks by just recommending that they get the same ROE as other regulatory commissions have awarded other utility companies? Wouldn't that be easier to do?
It might be easier, but it would be inaccurate, and it would be problematic. I mean, it hasn't happened in a while, but it was back in the I think it was in the early 80s, that the market to book ratios for utility companies were actually below 1. So that was actually problematic, and work had to be done to kind of correct that. But if you just looked at authorized ROEs at that point, it would have probably been too low, right? You had to look at the capital markets and how they're reacting and account for that. And now we have the opposite. We have market to book ratios that are really high, and to just ignore that is to say, let's basically ignore how markets are reacting to authorized ROEs. If we do that, there's no point in presenting testimony. There's no point in doing any of this. It's just stick to other authorized ROEs. We have to look to capital markets. So we can't, authorized ROEs cannot be our gauge. It has to be to the capital markets.
Thanks. And I think you were just getting at this a second ago, but given your experience testifying before various commissions around the country and your general knowledge about utility regulation, is it your opinion that ROEs authorized by other regulatory commissions accurately reflect the market cost of equity capital?
I don't think so. I think the market is telling us directly that that's not the case. I mean, just that I wouldn't recommend setting and calculating the cost of equity just by something as simple as the market to book ratio. I think it's more complicated than that, but it's staring at our face. So it's such a simple way with no one's even denying that. I mean, market to book ratios for utilities 1.5, 2, in some cases 2.5 or more. So it really is the market speaking and saying that these authorized ROEs are higher than the cost of equity.
Thanks. Have you reviewed Dr. Woolridge's rebuttal testimony in this case?
Yes.
Okay, I'm going to Ms. Lupoli is going to hopefully put the second of our images on the screen. There it is. There it was. Have you had a chance to look at this chart without the, is that a dog on it? Without the, without the pink square in the upper right-hand corner?
Yes.
Okay. And for the record, is this chart on the screen, does it say figure 2 Warner and Jarvis 2022 study results at the top?
Yes.
Okay. And would you accept, subject to check, that as published in Dr. Woolridge's rebuttal, the next line says electric and gas authorized ROEs and capital cost indicators?
Yes.
Okay, and that portion is unfortunately covered on this screen. Can you tell me your understanding of what this chart shows?
Yeah, it's a very helpful chart. It basically shows that authorized ROEs have not come down as interest rates came down. Now, I mean, as I had mentioned, I think a little earlier, that we talk about cost of debt or interest rates compared to equity. It's not going to be perfect, right? There are different characteristics between equity and debt. However, they do tend to move together. I mean, you expect as interest rates go down that the cost of equity would go down and vice versa. But you can see, I think, that when it's back in the early 80s, I think I was talking when market to book ratios at that time had flipped. I think we're below 1 for a little bit. I mean, since then, as interest rates had come down, all these different categories, I think for corporate bonds and treasuries of different maturity lengths, as they've come down, for the most part, authorized ROEs started to come down with them, but not by as much. So that's one important data. I'm glad Dr. Woolridge put this in here. That really helps understand what's going on here. We don't know. This is more additional market data that shows that the cost of equity, the authorized ROEs probably have not followed the real cost of equity. I mean, that really parallels this idea of the market to book ratios have also increased. That's consistent with this market data as well.
Thanks. That was actually going to be my next question, was whether you feel that this chart aligns or conflicts with your testimony from earlier about the departure between authorized ROEs and market to book ratios historically.
No, they reinforce each other. Yeah.
Thank you. I was looking at Exhibit ALR 5, which is PDF page 153 of your testimony. And that shows market to book ratios of your proxy group as one of the data points.
ALR 5?
Yes.
Page
153 of your PDF is what I had it as.
But it's Exhibit ALR, I have page 1, page 2.
One moment. Page 1, ALR 5,
1.
page 1.
Yes, I'm there.
You've talked about it a little bit, generally, the importance of the market to book ratio. Can you explain why you've provided the market to book ratio for your proxy group for Pura's consideration?
Well, it's part of just my calculations, but I think it's also just here I think represents valuable information in a similar way to Dr. Woolridge's figure 2 and the discussion in general. This just does show that the market to book ratios for each and every one of the companies in the 7 companies in my proxy group are above 1, significantly above 1. You have, I think it's Atmos ATO has a market to book of about 2. It's between 1.86 and 2.06. I think it was NiSource is 2 to 2.24, and some of the others are down around 1.5. So it's just just some market data on a high level to show. I mean, because just have to remember when in rate of return regulation, authorized rate of return is applied to rate base, which is when the portion that's funded by equity is nearly identical to book value. So if someone's paying a premium for this, the market's saying that we're happy with a lower return. I mean, that's just the math. If the market to book ratio is about 1, they'd be earning about the same as the authorized ROE. Since they're paying more, they're going to be accepting less. Now, again, I don't suggest setting authorized ROE based on something that's simple. It's more complicated, but this is really, really strong evidence that the authorized ROEs have been been and are higher than the cost of equity.
Thank you. Beginning at page 37 of your testimony, you discuss volatility. And I'm hoping we can cover some fundamentals. I always struggle with this part of your testimonies. And it's me, not you. So starting at the most basic, like any market, the price of equity markets, the prices on equity markets fluctuate. Is that correct?
Yes.
So if I bought stock for $25 today, I couldn't reasonably expect that still to be worth $25 next week, tomorrow, or maybe even 5 minutes from now. Like, it's possible, but the volatility of the market would increase the risk that I couldn't expect the same result in the future. Is that accurate?
Yeah, exactly. And if you just looked at stock price movements over time, you'd see they're not flat, they move. And we could see that just looking back, and we can also see it, as I think we're going here, in terms of what investors know that. And you can see it based on capital market data that investors do expect that stock prices could go up or down, and they do.
And you can view volatility on the market historically pretty clearly by, like, you could look at the S&P charted over time and see that it's a line that bounces up and down historically, right? Can you also, is there a way to observe expected volatility in the future?
Yes, there is a way, and the most common way that people look at is called the fear gauge, which is the VIX index or the fear gauge, and that's what Mr. Novak discusses in his rebuttal testimony quite extensively, is discussing that. It's very common as a fear gauge. So that the reason why that's a powerful gauge and why people look to it is because it's not just looking back, because it could change, right, on a dime. And we can see, based on option prices, we're able to determine how fearful people are. And since you're struggling with it, I'll just give one simple example, because I tried to go, because this is a really difficult topic here, this idea of option implied vol. And so I think it's actually quite intuitive in a sense. And so what I just did was I went into my fifth grade, my fifth graders, I explained in class, I brought this chart in, even where you're going, the three-dimensional chart, to explain this. And the big question is, I started off by saying, who in here likes ice cream, right? And they all liked ice cream. They said, imagine this idea of fear, the fear of not getting ice cream. Could you imagine this? And I said, yeah. So I said, as a rule, imagine if the guy selling ice cream outside your school, he leaves if it rains, and he stays if it's good weather. I said, would you be concerned if it was sunny? I said, no. What happens if it's cloudy? Oh, yeah, they'd be concerned if it's raining. Yeah, they'd be very, very concerned. Right? So I said, how could we measure that? So we could do some kind of survey. How scared are you? And another way, we could have a market where you would pay to cut in line to go get your ice cream early, right? So when I ratcheted up those things, one kid immediately said, yes, he would, at a certain point, he would give his dog to get ice cream, right? So it was, I think, in some sense, it's abstract. In another sense, it's very, very, very concrete on that level of these 10, 11-year-olds, that you can see if you're willing to pay more for some contract that would allow you to deal with uncertainty, that's a great indication of just how fearful someone is. In that case, kids and getting ice cream. But it's the same here with these kind of option contracts. They're going to run up as soon as that rain's coming in or something related to financial markets. You're going to see it. It's not people's opinions or someone sitting around. It's just real time. And so that basically underpins the different charts. I don't know if you're going to go through some of these, but if you are, that underpins everything here.
Thanks. I am. I actually am going to ask you about the 3D chart, but I'm going to start with the chart 8 first, which is the next slide that we have, Ms. Lupley. And thanks for that. I didn't understand economics until my professor told me about a hot dog cart and the length of a line of it. So I appreciate the ice cream story. So this chart, which is chart 8 from page 40 of your testimony, Can you just explain what it is that this chart is showing and the relationship, if at all, to what you were just discussing?
Okay, so yeah, great. So just going back, think of the ice cream analogy again. Imagine the blue line at the top, which is COVID and financial markets, but this would be a big rainstorm in the ice cream analogy. So what it would be is when you look at the numbers on the x-axis, that's like fear, right? That's the implied volatility or a gauge of the fear amount. The higher, the more fear. The y-axis is time going forward. So the blue line, you'd imagine it like rain has come in right now, and the kid is giving his dog for the ice cream. But over time, he's willing to pay less. Meaning he thinks it's a guess if that time was hours or something. Over the next 24 hours, he thinks it's still a chance of rain, but less, right? Less of a chance. So very afraid, but I think tomorrow it's going to get a little bit better, right? So that was COVID, and so not surprisingly, that was a tremendous amount of fear. But what the market data was showing was that people thought that the uncertainty would go down over the next couple of years, still heightened, but go down. So that's what we call the term structure of volatility, or a kind of, in a sense, a term structure of fear. Right? And then the one below that, the orange line, is when Russia invaded Ukraine in March of 2022. That was also elevated. People were afraid and uncertainty, or greater amount of potential volatility in the markets, right? They had a little bit of a different shape. It was flatter, right? So for whatever reason, they expected the intensity wasn't as high as COVID, but they expected it to kind of be maintained longer. And then we can go down and compare to some other time frames in there, but I think the one that's important to go to next is today. So the yellow line, the one that's February 25th, 2025, is the data that I used as of the end of the period for calculating my cost of equity. So you can see that it's significantly reduced on all levels of fear, and uncertainty in the future is on all of the full term structure, moving out from 1 month to 24, is lower, much lower than during COVID, and much lower than during the initial invasion of Ukraine.
Thanks. So at the most basic, is the idea here that what this is demonstrating, like that orange line for February of 2025, is demonstrating that the expectation of volatility is relatively flat as compared to kind of more volatile, more concerning times in recent history?
Yes, that's one slice. We go to the three-dimensional piece next, but yes, when we just look at that one slice there at the end of February, yeah, that shows that it's relatively low risk compared to those times, but it's slightly elevated compared to before COVID. So.
Okay, and I do have the three-dimensional chart as the next slide, Ms. Lupoli. I think I often ask you about these similar charts because this one is the hardest for me to. Once you hit 3 dimensions, I'm lost. So.
Well, the great thing was when I presented this in the class, one of the kids corrected my axes, so I knew he got it. So it was great because I didn't think I needed to change the axis for them. But this is just. We had the slices there. I think it's understandable. You have this idea of being measured a term structure of fear, like how fearful are you in this first hour or first month and going out. This is taking that and flipping it. So that it allows us to see those slices over time, right? So each one, like you can clearly see the peak in the very beginning there in 2020, that great peak in the beginning, that's COVID, right? So, and then it would be like you were staying at the top looking forward, right? It would go down the backside of that would be a declining term structure of volatility. Then we can see how that changes, over time. I think the beauty of this, why I like putting it in, I hope people appreciate, is just how much information capital markets can provide. I mean, not just how fearful they are, but over different time frames and various things. So it's quite amazing, the richness of the data that's available here, right? So that's really what it is, the slices over time. So again, it's so clear with COVID. And I think if you followed, you could see where it kind of spiked during in 2022 with the war in Ukraine as well. Then coming down to today, of course, at you can see kind of where we are now as well. So I hope that's really understandable, seeing how those slices change over time, and just really the point of to show the richness of really the data that we can see in terms of understanding investors' expectations, their appetite for risk, and calculating the cost of equity.
Thank you. The last chart I wanted to ask you about is our next and last slide, which is chart 10, which is specific to your proxy group, as I understand it. And I think this is going back to the VIX index. Is that correct?
That's right.
Can you just explain what this chart shows?
Yeah, so this is just to show a comparison, because what I was able to calculate as well is we have the VIX index, like I said, this Chicago Board of Ops Exchange calculates to measure fear. I did using the same math. I calculated what that would look like for the proxy group. So kind of a fear for the electric gas companies. So that you can see kind of how it changes over time. And the interesting thing, though, is just the reality is there has basically, they were mirroring, I mean, it depends. There was different times. But if you go back to COVID in the beginning, you know, that initial spike, the fear for the overall market was a bit higher than for the gas utility companies. But then there were different times where that option implied fear or volatility for the gas group was a bit higher in 2021. And then that happened again starting in 2023, where the volatility expectations for that group were higher than for the overall market. And that was over at the 6-month time frame. And now they're pretty much in line, but even now they're slightly elevated for the gas group. Now, why is that? Part of it is you don't have as much of like a portfolio effect. You only have 7 companies, right? But this is just a reality that my methodology will pick up, and it is showing that in this one regard, there was some greater uncertainty or volatility expectations for the gas than for the overall group. As I explained, to relate this back to the cost of equity, you also have to consider that next moment in statistics, which is skewness, because you have to bring it back to in the theory with the capital asset pricing model is what matters is not just that volatility, that uncertainty, but how that uncertainty relates to the overall market. So you have to bring it all together. But this is very, very interesting. It was surprising, but there were considerable times there where the implied vol was a bit higher for gas groups, gas companies than for the overall market.
Thank you. I just have a couple questions. The last set of questions I have are pertaining to page 97 of your testimony, which just very briefly discusses the proposal from the company to account for flotation costs in the cost of equity.
Okay.
Flotation costs are the like transactional costs that arise from the actual issuance of equity. Is that correct?
Yes.
Are those, as you understand it, costs that are incurred by the parent company for when it issues equity to like on the publicly traded stock market?
When they go and they hire an investment banker to issue equity, they would have to pay the investment bankers then fees. Yeah.
Okay, so in this circumstance, would your expectation be that that cost is incurred by Eversource or Yankee?
Well, since Yankee isn't issuing their debt, I think Eversource would be paying the investment banker, as I understand. Yeah.
Okay. And I saw in your direct testimony that you disagreed generally with the inclusion of flotation costs because of your expectation of the transaction itself, correct?
Well, the main argument that with the market to book ratios so high, when they go out and issue stock, the way it works is really a profit center for the company. It's basically the opposite of dilution that's happening. So there's really, anytime a utility is going to have that opportunity to issue more equity, since it's a profit center, it seems a little bit unreasonable to charge consumers for any of those fees to the degree they're there.
Would you agree that a company that has said on the record that they will not issue stock in a circumstance where they would lose money from that transaction would expect that profit center effect in a stock issuance? In other words, if a company were on record saying it would not issue stock in a circumstance where where investors would lose money as a result of that transaction, so issue stock at a point where the market price is lower generally than the value of investor portfolios, would that statement support or conflict with your testimony suggesting that including flotation cost doesn't make sense?
I'm not totally sure, but it doesn't sound like it contradicts what I'm saying, though. No.
Okay. Thank you. That's OCC's final question for this panel.
Okay, thank you. I think we're going to go ahead and take a lunch break so I don't have to interrupt the next panel. So let us break till 12:45. Thank you.
Yeah. Yeah. Yeah, so yeah. Yeah.
Attorney Pace?
Yes, thank you. I'd like to raise a procedural issue for the commissioners to consider. And that is during the cross-examination that occurred of Mr. Rothschild by the OCC, there was some brand new information offered on the issue of the capital structure of the subsidiary and the parent company. So therefore, we'd like permission at the conclusion of this cross-examination to offer very brief rebuttal testimony from the Eversource panel, and I cite the following legal authority in support of our request. So the first citation would be the authority's regulation 16-1-39 entitled Order of Proceedings at Hearings, and it states, and I quote, "In hearings on complaints, applications, and petitions, the party that shall open and close the presentation on any part of the matter shall be the complainant, the applicant, or the petitioner." So our proffered interpretation would be, in this contested case, where Yankee Gas is the applicant, the regulation states that the party that shall open and close the presentation on the evidence shall be, in this case, the applicant. The other authority we'd like you to please consider in evaluating this request is General Statute 4-177C, subsection A. I'm not going to read it in its entirety. I'm just going to read the relevant language. It says, in a contested case, each party, and it has ellipses, shall be afforded the opportunity to, again, additional ellipses, at a hearing to respond and to present evidence and argument on all issues involved. Because this is a contested case, we're at the hearing, Yankee Gas is a party to the proceeding. We would like to rely upon our ability to respond to the new evidence through offering verbal testimony and rebuttal from our panel, and as well as the right to present evidence and argument on all issues involved. The scope would be very brief. I'd request permission to bring up witnesses O'Neill, Callan, and Horton, and ask them just a few questions to react to Mr. Rothschild's testimony on the issue of capital structure between parent and sub. And so because you have Mr. Rothschild up there already, our request would be at the conclusion of cross-examination, I have the ability to produce that panel of O'Neill, Callan, and Horton for those very brief few questions. And of course, other parties can then cross-examine our witnesses on those issues if they have any cross-examination. So I'm happy to take any questions on our request, Chairman.
Thank you, Attorney Pace. Does any other party or intervener wish to be heard on the request?
Sorry, just one brief question. So you stated that the new testimony is related to parent and subsidiary on capital structure?
He he suggested that it should be the same. And the fact that it should be the same is the issue we'd like to offer additional testimony on. I know that in his pre-filed testimony, he does talk about the issue of the parent company capital structure, but at least it's our position that the claim that it should be the same is something that we'd like the ability to be able to respond to in rebuttal testimony, very brief rebuttal testimony, subject to making my panel available for cross-examination.
Thank you. Any other party or intervener wish to be heard? All right, Attorney Pace, from my notes, what was the second citation? It was 16, I got the regs, but the second citation was 4 dash.
Of course. The second citation was General Statute 4-177C, subsection A, and I just read the relevant language which in my view applies. Of course, it's a much longer paragraph, but I focused on the relevant language that I believe supports our position here.
Thank you. One moment, please. I just want to refresh my recollection. Okay. All right, Attorney Pace, believe that we will allow that. So after this panel concludes, I allow the company to recall its 3 specified witnesses subject to the other parties and interveners' right to cross them on the proffered testimony.
Thank you, Chairman. I appreciate that.
Thank you. Okay, for now, let's resume with cross-examination of this panel. So I believe we have 2 cross-examination of EOE's panel conducted by the company. Please, Attorney Hum.
Thank you and good afternoon, Mr. Rothschild. So you're recommending an ROE of 8.19% in this proceeding, correct?
That's correct.
And although your recommendation is the 8.19%, the midpoint of your estimate of the proxy group cost of equity is lower at 7.46%, correct?
That's correct.
And normally practitioners start with the midpoint of the range. So why did you choose the higher end of your range?
You know, my first reaction is to say, yeah, generally the midpoint, but I've seen people in different parts of the range. I in general, so I don't know if I could say in general. I think that I went to the end of my range, the high end of my range, because it's I think it's just, well, first of all, the main part of my testimony is to provide the range and my COE model results that the authority could consider in terms of setting the appropriate authorized ROE. In terms of here going with the high end of the range, I think it's reasonable in terms of, as we've had a lot of discussions here about authorized ROEs being higher than the market-based cost of equity. There's a lot of evidence for that. I think it would be reasonable to move in that direction over time. So going with the high end of the range, I think would be a good step in that direction.
And what is your recollection of the company's currently authorized ROE?
I don't recall it. I've dealing with a few different numbers. I don't recall exactly. I know it's higher than my recommendation. Yeah.
Would you agree, subject to check, that it's 9.3%?
Yeah, that's what I was thinking it was. Yeah.
And that ROE was a result of a settlement approved by PURA in December 2018, correct?
That's my understanding.
Now, the U.S. Treasury bond rate is widely recognized as a risk-free rate, correct?
The U.S. Treasury?
Correct.
Treasury bills or Treasury bonds?
Treasury bond.
Treasury bonds are not risk-free. Yeah. They have a non-zero beta. We had, a bank, Silicon Valley Bank recently went bankrupt because of their holdings of these bonds. So it's just important to recognize they're not risk-free in the sense of they have risk. Yeah.
So if I said to you that the average yield of the 30-year Treasury bond was 3.11% in 2018, would that sound about right to you?
I would agree, subject to check.
And as part of your preparation in this case, did you review Mr. Novak's testimony and exhibits that he filed in the case?
Yes.
And in your preparation, did you review Mr. Novak's exhibit YGS-ROE-7?
Yes, I have. Are you pointing me to something in there now or just a general question?
Sure, I'll ask a general question, and if I need to point it out specifically, we can pull it up. So the general question is, Mr. Novak's exhibit YGS-ROE-7 at page 2 shows quarterly averages of 3.02%, 3.09%, 3.06%, and 3.27%, correct? And we can take a moment to pull that up.
You're referring to Novak's rebuttal testimony or his direct?
His direct testimony.
That's YGS ROE 7?
Correct.
Okay, so I see on page 1 where it starts in 1992, correct?
Correct.
And you were just referring to, again, which year? Is that what you're referring to? Maybe, sorry, now that I have it open, please point me in the right place.
Sure. So what I'm referring to are quarterly averages of 3.02%, 3.09%, 3.06%, and 3.27%, correct? And if I can clarify, Mr. Rothschild, that's for 2018.
Yes, I see that. Q1 2018, 3.02%, and then you read up to Q4, which is 3.27%. I believe that's for the yield on the 30-year U.S. Treasury bond.
And the average of those numbers is an average yield on the 30-year Treasury bond of 3.11%, correct?
It sounds right.
In Mr. Novak's exhibit YGS ROE-7 at page 2 that we're on also shows that the yield on the 30-year Treasury bond has been higher than 3.11% since sometime in mid-2022, correct?
That's what it shows, yes.
And looking at this exhibit, the 30-year Treasury bond consistently has been in the range of 4.00% or higher since mid-2023, correct?
That's correct.
And in fact, the yield on the 30-year Treasury bond is now up by about 150 basis points since 2018, correct?
As of now in June 2025?
Based on what's shown in this exhibit.
Comparing it to the most recent figure here is a 4.23%. So that's what you're referring to?
Yes.
It's not quite 150, but is that what you're?
But it's
over 100 basis points.
It's over 100 though, correct?
Sure, yeah.
Thank you. So you're recommending in this case that Yankee's ROE be reduced by more than 100 basis points from the last case, correct?
My role is to provide an evaluation of their market-based cost of equity in terms of what capital markets are indicating, as I show in a lot of the data that I examined today. That's the objective of my testimony.
And your testimony makes a recommendation, correct?
Yes, based on what capital markets are indicating the market-based cost of equity for Yankee is. Yep.
And your recommendation is that Yankee's ROE is more than 100 basis points lower than from the last case, correct?
No, I'm not making a comparison to the last case. I'm saying what capital market data is indicating today. And yes, I'm going to the high end of my range because of a general, in general, authorized ROEs have generally been higher, right? So I'm going to the high end of my market-based range. But I'm not making any statement or comparison of how the cost of equity has changed since 2018.
Sure, and I understand your response. So the question is not that you are making the comparison, but the question is that if you compare the two numbers, your number is more than 100 basis points less than the approved ROE in 2018, correct?
I think so. I just want to make it sure that I explained my role and what my recommendation represents.
If the risk-free 30-year Treasury rate has increased since 2018 by more than 150 basis points, and you're recommending an ROE that is at least 100 basis points lower than the current authorized ROE of 9.30%, is it your testimony that the risk premium that investors require to invest in a gas utility company has decreased by 250 basis points since 2018?
No, I'm not saying that at all. I think you're mixing up a few things there. I mean, you're referring to risk premium as comparing authorized ROEs to U.S. Treasuries as a definition of market risk premium. I would not define it that way.
Well, let me break down the question then, and I appreciate the clarification. So the risk-free 30-year Treasury rate has increased since 2018 by more than 100 basis points, less than 150, but more than 100 basis points, correct?
I just want to make sure that I did not agree. The 30-year U.S. Treasury is not a risk-free rate. You talked about it as some generally accepted measure of a risk-free rate. Maybe that happens. Of course, it's not a risk-free investment. Just to be clear.
Okay, and I'll clarify. I'll rephrase my question one more time then. Thank you. If the 30-year Treasury rate has increased since 2018, withdrawn. The 30-year Treasury rate has increased since 2018 by more than 100 basis points, correct?
Yes.
And you're recommending an ROE that, even though it's not a comparison, the numbers themselves is 100 basis points lower than the currently authorized ROE of 9.30%, correct?
That's right.
So is it your testimony that the risk premium that investors require to invest in a gas utility company has decreased by more than 200 basis points since 2018?
I explained, it's interesting. You're talking about I understand a risk premium and as a relationship to authorized ROE. That's why I'm struggling to kind of respond, because the definitions are getting a little bit mixed up here. But I'm not saying that I don't say in my testimony what I believe the market risk premium, how it's changed since 2018. I'm just looking at what the market is indicating the cost of equity is today. And we just have to be careful about talking about comparing authorized ROEs and some other instruments and discussing that as if it's a market risk premium in something to do with the cost of equity. It's not, right? Because unauthorized ROEs are applied to book value, right? It's an accounting measure. You have to be very careful mixing those concepts. So I know, so I think I've answered, this is my recommendation based on what capital markets are indicating. And I caution about referring to cost of equity and the change of cost of equity and authorized ROEs compared to yields on US Treasuries.
Is it your testimony that authorized ROEs for gas utilities are trending down in the current environment?
In my testimony, authorized ROEs are trending down. Remember, the focus of my testimony is on what capital markets are indicating. I don't have an opinion or look into where authorized ROEs around the country are trending.
So if I were to rephrase my question and ask, which is I think what you just stated in response, but would you be able, or withdrawn, would you agree that authorized ROEs for gas utilities are trending down in the current environment?
And over what time period, what environment, in recent weeks, months, years, or?
Why don't we say since 2018 in the last rate case the company had?
You know, I don't, the focus of my testimony is on what capital markets are indicating. I didn't do an analysis to see how those have trended since 2018. I don't know offhand.
Okay, thank you. Now, the primary tactic that you've included in your analysis to drive a substantial reduction in ROE is the use of options contracts to estimate volatility, correct?
Could you repeat that question?
Yes. The primary tactic that you've included in your analysis to drive a substantial reduction in ROE is the use of options contracts to estimate volatility. Is that correct?
Well, if you look at my capital asset pricing model, the average of my 4 results, 2 of which, I have 8 results. 4 of them have the option implied betas, which I think you're referring to. I get a result of 6.97% on average. If I remove those option implied betas from there, my result is a 7.41%. So removing that from the conversation, still my recommendation is higher than those results.
Thank you. And I think my question was a little bit different. I wasn't asking you about the results. I was asking, is the primary tactic that you use as part of your recommendation in this case the use of options contract to estimate volatility?
I'm not sure what you mean by tactic.
Methodology, tactic, argument, position, anything along those lines with respect to your position in this case.
So we could use the term method as opposed to a tactic, I guess. Those are interchangeable.
Sure. So the method that you have used as part of your argument and recommendation in your materials in this case.
Yes, as I was explaining before, when OCC was crossing me, one of the important things I like to offer is what capital market data is indicating. And I were able to go through those charts and show the comprehensive amount of data or comprehensive amount of information that can be provided by stock options. I think that's why Mr. Novak himself opens up early on in his rebuttal testimony, the very same concept, which is option implied volatility or the fear index, the VIX index. So that does really fall, I think you're characterizing correctly in terms of the bedrock of my methodology is to try to use as much of that market-based information as possible, and the primary piece being stock options. Of course, I have other methods. My sustainable growth DCF method does not use options, but I would agree with that is a primary part of my analysis and really what I aspire to include as much as possible in my methodology.
And when you talk about stock options, an options contract is an agreement between 2 parties to undertake a potential transaction at a preset price at some future date, correct?
Yeah, it's the right, but not the obligation to buy or sell the underlying. So they're directly as a call or put option. Their value is mathematically directly related to the underlying stock, right? It is the stock move that's what impacts the stock option. That's why you call it the underlying, right? This is a derivative of an underlying stock. So it's their value is mathematically connected to the underlying. But as you said, it is based on a contract with certain rights and obligations of buying and selling.
So when executing an options contract, the parties are agreeing to either buy or sell a stock at a certain price in the future, correct?
Yes.
And options trading is a practice undertaken generally for the purposes of hedging or speculating, correct?
Now, option trading is widely used for many reasons. There are people who speculate with options, and people who speculate with regular stock as well, and same with hedging or managing risk in general.
But you can agree, though, that there's a meaningful number of investors that use options for either hedging or speculation, correct?
Certainly, especially since there's been an explosion of the use of stock options since, certainly since right before COVID and into it. And one of those big growths have been like 0-day options and so forth. That's where a lot of the speculation is my understanding. When you talk about speculation, people literally trying to make money over the course of a few hours. I don't use any of those types of options, 0-day options or anything like that in my analysis.
Do you view setting the ROE for the return on utility assets to be the equivalent of hedging or speculating on stocks in the financial marketplace?
The important, the authorized ROE should be set equal to the cost of equity. That's the main point. So we have to look out into the capital markets to see what returns investors are demanding. That is the key principle. When it comes down to this idea of options, I think based on the question, I can tell the idea is these are somehow different because they could be, for whatever reason, they're used for some other reason. But it's really critical. They are mathematically connected and linked to the underlying. So it's that's my answer.
So to try to clarify and bring it back to whether the response is more along the lines of a yes or more along the lines of a no, do you view setting the ROE for the return on utility assets to be the equivalent of hedging or speculating on stocks in the financial marketplace?
To be honest, I don't understand your question.
Okay, fair enough. I can move on then. You would agree that options contracts generally apply only for a defined period of time, correct?
Generally, options on the S&P 500 go out to 6 years. Right? So that's how far they go.
A call option is the right to buy a stock at a certain price, correct?
Yes,
And a put option is the right to sell a stock at a certain price, correct?
that's right.
Typically, that buy or sell contract expires at some point, correct?
Yeah, the furthest out for right now are six years on the S&P 500.
Can you please turn to your direct testimony at page 70, lines 9 through 11?
What were the line numbers again?
It starts at the end of line 9 and goes through line 11.
Yes, I've read that.
And there you state option times to expiration vary significantly for various stocks, but can fairly consistently be found to go out to 6 months, parentheses, 180 days for utility companies, correct?
That's right.
So you chose to calculate a 6-month volatility and skewness where possible, correct?
Yes.
And your option implied beta analysis focuses on contracts that run over a 6-month period where investors contract to buy or sell at a certain price, correct?
Yes.
So is it your testimony that a 6-month option contract will accurately mimic the investment horizon that a utility investor would have for the direct purchase of a utility stock?
Yes, I've seen a lot of evidence that's the case. I think that the research that I cite had found originally back at that time that there was evidence that the option implied beta is calculated over the 6 months, because they focused on 6 months as well, had predictive power out beyond those timeframes. And so, yes, when I was first developing this back around 2018, I mean, I've been blown away since just how well to be honest, how well this has performed in that regard, because when we had COVID, for example, betas jumped up at that time, historical betas over all different timeframes and option implied betas as well, right? But then a few months later, option implied betas came down, and following those, like a waterfall, all of the historical betas followed suit, right? And just as predicted, just starting in recent months, the 5-year historical beta has been coming down as well, in line. I think this is a great indicator that option implied betas are a great indicator or a forward measure of what historical betas would be. So to the degree that historical betas mean something, including 5-year historical betas, option implied betas are been really the data is showing they're a good indicator of forward measures of risk, which is what we're trying to do here.
So speaking of what we're trying to do here, what information have you submitted in the record in this case indicating that utility investors buy stock to hold it for only 6 months and no longer?
There's no way to know exactly how long any investor is going to hold it. I mean, you can have different investors over all kinds of different time frames, right? But the data is showing that over this 6 month time frame is a good measure of what historical betas over longer time frames will be in the future. So I think that data is indicating it. So even if all investors only go in and buy and hold for decades at a time, right, there still is showing to be a relationship between this 6 month time frame and longer term frames. That's what the data is showing.
So specific to my question, when you're referring to what the data is showing, what information is in the record in this proceeding that shows that utility investors buy stock and hold it for only the 6 months?
I don't show any of it. I don't know how long. I didn't do any study to determine how long, on average, investors are holding utility stocks.
Now, can you please turn to your direct testimony at page 64, lines 12 through 15?
Yes, I'm there.
And in your testimony, you state that you use option implied betas in your CAPM analysis because studies have found that betas calculated based on investor expectations, option implied, provide information regarding future perceived risks and expectations, correct?
Yes.
And in footnote 69 on that same page, you cite to an article by Chang, Christofferson, Jacobs, and Vainberg, correct?
That's right.
Is that the study that you're referring to in lines 12 through 15?
Yes, and I just gave a minute ago that what I explained, the waterfall effect, and that's my own analysis that has, this study was done, published in 2012, right? So a lot has happened since then. When they said that study, a lot of work, of course, needed to be done. And I think that I've done that, right? I've done a lot of work and shown, especially given COVID, the fact that option implied betas were a forward measure of historical betas over all time frames, from 6 months up to 5 years, is a wonderful additional evidence that this paper didn't look into at that time. But yes, this was the initial paper that I'm referring to that had done some of the initial research on this topic.
And when you refer to studies plural in that sentence from page 64 of your testimony, the footnote at the footnote 69 on that page is just one of 2 studies published, and they're both by the same authors, correct?
Yes, the option implied betas were developed by these researchers.
And there's no other study that has ever validated the option implied beta theory, correct?
Well, recently I've come to know that option metrics is the data source that these researchers relied upon, has started calculating option implied betas and publishing them and selling them to major financial institutions, option metrics. So it is now widely available to investors, and as my understanding, they're publishing their own studies and research to explain why it's valuable for major funds to use.
Are those studies in the record in this case?
No, I just became aware of that.
Now, you provided a copy of the Chang article in response to an interrogatory from the company in YGS-EE-01-03, correct?
Yes.
Now, if you can turn back to your direct testimony at page 70.
Yes.
We talked about you're calculating your option implied betas. You use option contracts that expire in 6 months or 180 days in the future, correct?
Yes.
But if you turn to that Chang study on page 421, which the document itself, it would be page 37 of the document. They state that the focus of the paper is forecasting 180-day ex-post betas that are relevant under certain applications such as abnormal returns, correct?
It does state that, yes.
And the authors continue to state that for other applications, such as cost of capital calculations, longer horizon betas may be needed. Is that correct?
Oh, yeah, I would agree. That's why I've done a lot of work since then. They didn't have near as much data to work with because they said stock option trading has ballooned since then. So I've studied option implied betas over different timeframes. And I've mostly seen a declining term structure of betas. Right? So when we go out further for some electric utilities and stuff, they go out 2 years. So every time that I've seen that, it's indicated that option implied betas on the 6 month time frame are conservatively high. So I would agree, and that's why I continue to look into leaps. That's why option metrics, they're coming out, they're doing the full term structure of the option implied betas, going out as far as possible, which I completely agree, and which is what I work on doing as well.
Based on what the Chang study states on page 421, that source that you rely on doesn't validate the use of 180 days for cost of capital calculations, correct?
I think this has provided an excellent base for work to be done, as I've done, and also now the firm Option Metrics. I'm publishing this for major funds to use. As I've discussed, there's just tremendous amount of evidence that I've seen that option implied betas on the 6 month time frame are a wonderful measure of what we're looking for in terms of the cost of equity over longer time frames. I mean, I was just looking at when I had when Mr. Novak had filed his testimony back in October. So I kind of looked at what betas were at that time, and option implied betas were higher than historical betas at that time. And when I filed my testimony, as I'm sure you've seen, the historical betas were higher. The option implied betas were 0.55 to 0.61. The historical betas were in the 0.7s. When I just start looking at the data as of the end of May, the historical betas have come down in line with the option implied betas. It's another beautiful measure of not only how option implied betas are a forward measure of historical betas, but also when you look in kind of totality, how they act as a smoothing effect, I think, to the degree you're trying to set an authorized ROE that is not only market-based, but is also smoothed. It provides just another wonderful example of how helpful they are.
Are you able to point us to any academic study or financial research that supports the use of the 180-day options contracts as the basis for setting a utility's authorized rate of return?
I've been focusing more on the kinds of work that I've been doing, discussing that what I refer to as the waterfall, with the option implied betas being a forward measure of historical betas. Also, another example is looking at when PG&E went through bankruptcy. We could see the option implied betas for 6 months, and the 6-month timeframe jumped up immediately as soon as investors had realized they were going to be on the hook for wildfire liabilities. Many of the witnesses in that case had said, we know that the cost of equity for PG&E has gone up, but there's no way to measure it. Immediately we saw the cost of equity for PG&E had jumped by hundreds of basis points on a dime. Is there another very powerful measure of how it represents a real-time measure of investors, the cost of equity?
So back to my question, though, are you able to point to an academic study or financial research that supports the use of the 180-day options contract as the basis for setting a utility's authorized rate of return?
I haven't. I haven't, but like I said, I'm still reviewing what I learned recently. The Option Metrics is providing this, and I don't know if they're focusing on the 180-day time period. Actually, I do know they're providing the full term structure, which I agree with, going out as far as available with the leaps or the longer structure, longer term options. But I don't know if they're addressing the 6-month or not. I do know that they're basing their methodology, Option Metrics, on this research as well by Christopherson and Chang as well. But I don't know if they're emphasizing the 6-month horizon or not.
What are the studies that you're referring to that I asked about earlier, and I think you just brought up again?
About the waterfall?
About that validate the option implied beta theory.
This has been my own studies that I've presented in many testimonies. I have to see if I've done it. I can check if it's in the record here, but I commonly present it, which is just looking at how betas over different timeframes, historical and option implied betas, how they performed from the time of COVID during the turmoil in March and April 2020, and then over time, going out now 5 years hence, and seeing how all the betas jumped up, and a few months later, the option implied betas came down, and then the historical betas followed right along. So that's what I'm referring to.
Thank you. So just to confirm, when you talk about studies, you're talking about your studies, and you're not talking about an independent academic study or financial study that verifies the option implied beta theory, correct?
Those are the calculations that I made myself, yes. And I told you that the Option Metrics has now commercialized this and is selling it.
Do you view Pura's exercise in this case to be setting an abnormal return?
I don't understand your question.
Sure. So when we talked about the Chang article that you rely on for your studies, and I'm happy to read it again, but it refers to abnormal returns. And if you'd like me to read the entire sentence, I can. My question is, do you view Pura's exercise in this case to be setting an abnormal return?
I think the important, when you talk about abnormal, I think the point of that was to say that it has the capacity to measure change, right? If we have a thermostat in this room, we don't say, well, it's good at measuring change, but if the temperature hasn't changed, it's of no use, right? That is, so I think that's what's being implied here. The power of these is they can tell you when the cost of equity has changed or when it hasn't changed. In the case of the 5-year historical betas that are used regularly here, the issue, they've been elevated by COVID and have remained elevated for a long time, right? So basically that's like a broken thermometer. It still is picking up some kind of big temperature from a long time ago. So the key point of that is we want to have a methodology that has the capacity to measure the cost of equity, which means the capacity to measure change and the capacity to measure when things are not changing. So if an abnormal return is needed because capital markets are indicating that, then that would be appropriate. If it should be just the authorized ROE should be consistent with what the market-based cost of equity is.
So I think to the hypothetical that you just posed right there, do you consider returns for most utilities under current conditions to be abnormal returns?
Abnormal returns right now?
under current conditions?
I think I explained the power of this tool and the way that these authors are expressing it is the capacity to measure change, and particularly when something abnormal happens, like PG&E goes bankrupt, their cost of equity clearly goes up by hundreds of basis points. If you used a value line 5-year historical beta, it would say their cost of equity has gone up by 30 basis points. Is that true? No, right? It's just completely inaccurate. Or continuing to use 5-year historical betas that are influenced by COVID way after COVID. Is that an accurate measure? No. So the main point is the capacity to measure change. Are things abnormal now or not? The main point is this methodology has the capacity to measure accurately.
And in undergoing that measurement, which is the exercise of this proceeding, do you consider the returns for most utilities under current conditions to be abnormal?
I don't know how to answer. I feel like I've answered my understanding of this concept of abnormal in the research and what I'm doing. I'm not stating whether things are abnormal now or not. That's just not my testimony.
Excuse me, just for one moment, please. Thank you. Now, if we can please turn to the other paper that you cite in support of option implied betas, which is the Christofferson, Jacobs, and Vainberg study at page 16, and it's page 17 of the PDF or full document that you might have, that was provided in response to YGS EOE 0103. And let me know when you have that.
Go ahead. You can read me the line you like.
So in the third full paragraph on that page, there's a discussion of when forward-looking betas perform poorly, correct?
Yes.
And it states that, quote, "It is noteworthy that the forward-looking beta does poorly in a few cases where the average realized beta is either very low or very high. For example, the average realized beta estimates for Johnson & Johnson, J&J, and Altria, MO, and Procter & Gamble, PG, are 0.676, 0.544, and 0.612 respectively, and the forward-looking betas are negatively correlated with the realized betas in these cases." Is that what that states in that study?
That's what it states, yeah.
And if we can please turn to your exhibit ALR-4 at page 1.
ALR4, page 1?
Correct.
I'm there.
And this shows that the average forward beta that you used in your CAPM analysis was 0.61, correct?
That's right.
Now please turn to your direct testimony at page 75.
I'm there.
On this page, in the table that's on line 11, you summarize the results of your weighted average CAPM analyses, correct?
Yes.
And this chart indicates that you use a 0.75 historical blended beta, correct?
That's right.
Now turning back to exhibit ALR4 at page 3.
Okay.
And this chart shows the calculation of the historical blended beta, correct?
Yes, it shows yes,
And am I correct to understand that the historical blended beta average is calculated weekly in this page from November 26, 2024 to February 25th, 2025 for a total of 14 weeks?
that's right.
So this exhibit has 14 historical blend betas that you calculated, and then you average the betas based on the weightings shown in the table, correct?
That's right.
And specifically, you weighted the 6-month beta by 50%, the 2-year beta by 25%, and the 5-year beta by 10%, correct?
That's right.
What academic journal or financial market authority did you get these weightings from?
Yeah, this is just based on, I basically just based on my reviewing the data. I mean, my big concern, as I mentioned a lot, is using 5-year historical betas is concerning because it can be out of date. It's backward looking and going back so far. So I wanted to put more weight, I believe, on some more recent, like we want to use forward betas, which is really helpful, but in historical, I want to add some a greater weight to more recent periods. Exactly what this weighting should be could be debated. This is based on my judgment.
Thank you. So this is based on your judgment. Is there any investor or institution, though, that you can cite to that weights betas in these same proportions?
Yeah, this is certainly a discussion I have often, is this idea of what do investors do? And this, I guess, kind of this idea we could go out and, this idea that all investors go and open value line and put in this 5-year historical beta. I don't, there's not people, of course, what investors do as such. So there may be as many models as there are actually investors. So I think the idea of knowing what kind of weightings for anything is something that's not really knowable. So I try to really just focus on measuring what the data is showing as opposed to trying to find out what investors are actually doing. Because I don't think it's, I don't think there's any way to know.
Now, if you can please turn to your direct testimony at page 67. And it's at the very bottom, the Q&A that goes on to page 68. And there you describe your 6-month historical beta calculation, correct?
Yes.
And you describe how the 6-month historical beta calculation relies on closing price points from 26 days for each company and the S&P 500 index, correct?
Yes.
And you state that this is most certainly enough data to achieve statistical significance as addressed further below, correct?
Yes.
Is a correlation coefficient the same thing as a beta coefficient?
Yeah, there is, it's not exactly the same. Yeah.
Can you please turn to your direct testimony at page 128?
I'm there.
On lines 5 to 6, you state a correlation or beta coefficient of 0.505 or higher will occur by chance with a probability of only 0.01, correct?
Yes.
By that sentence, are you stating that a correlation coefficient and a beta coefficient are the same?
They're not precisely the same. Yeah.
And that's what you said a moment ago, that they are different, correct?
Yeah, it's helpful in terms of understanding the statistical properties, but it's not identical.
One moment, sorry. Thank you. Okay, thank you. So on that page 128 of your testimony where you refer to the correlation coefficient of 0.505 will occur by chance with a probability of only 0.01. When you say correlation, you're referring to the Pearson correlation coefficient, often abbreviated as R, correct?
Mm-hmm.
And if I wanted to calculate R squared, that means R times R, correct?
Mm-hmm.
So taking this threshold of a correlation coefficient of 0.505, that would be associated with an R squared of 0.255, correct?
Yeah, 0.5 times 0.5 is 0.25, yeah.
Correct, thank you. So while there may be a statistically meaningful relationship at a correlation coefficient of 0.505, that R squared would indicate that the proportion of variation in the dependent variable is only explained by a 25.5% of the variation of the independent variable, correct?
Mm-hmm.
So would you agree that while there may be a statistically meaningful relationship, that is a substantial amount of variability that are explained by other factors?
Yeah, that's why I, again, bring in the 6 months, do historical blended betas over many different time frames, including 5 years, and look at the forward betas as well. Yeah, I would not just rely on the 6 month alone.
Now, please turn to your direct testimony at page 50.
I'm there.
And there you indicate that you relied on a proxy group of 7 companies, correct?
Yes.
Do you believe that there's a minimum number of proxy companies that you should rely on?
Usually you don't run into that except with like pipeline cases before FERC, where you start to get really low amounts. But I mean, I think 7 is certainly a good number. That's why I use 7, and I'm able to calculate historical betas for all 7, right? And I'm able to do my sustainable growth method for all 7 and so forth. And then, of course, for these 7, there's, I think it's one of them. I have option implied betas for all of them for every single period, and then for others, I think 4 of those 7, I have to do some type of different types of interpolation because I have a very strict filtering criteria to make sure that any data that I use is meaningful, like the CBOE does when they calculate the VIX index. So I eliminate anything that would have any kind of liquidity issues. So 4 of those, that's what I do, and then there are 2 of them that I do not calculate option implied betas for because it would not be appropriate. But I think 7 is a good number. That's why I use 7. And like I explained, for these 7, I only 2 of them I don't calculate any option implied betas.
Could it hypothetically be lower than 7? Like, could it be 3 companies, for example, that could be comparable to Yankee Gas that would be sufficient to perform a market-based analysis?
That's why I use 7 and go. I use 7 for for most of my analysis. Yeah, for option implied betas, I calculate them for as many as I can, but I think 7 is a good number.
As the minimum number or as the target number?
Well, that's the proxy group that I use. There are 7 companies. I use as much data for these 7 companies as is available.
Thank you. And I guess maybe to ask my prior question a different way, could you have had less than 7? Could you have had 5 or 3 or 2 or somewhere in between?
My recommendation is based on the 7. I did not do an analysis to determine if 3 or 4 would have been sufficient, but no, I didn't.
And you mentioned FERC a few moments ago. Are you aware of the low-end outlier screen that FERC uses for any proxy company, DCF, or CAPM result that isn't sufficiently higher than the prevailing cost of debt?
I have heard of that. I don't remember exactly what the criteria is.
Now, for the 7 proxy companies that you have analyzed, you've presented the DCF results for all 7, correct?
My sustainable growth method is for all 7.
The CAPM result for any of your individual proxy companies is not included in the testimony or exhibits, though, is it?
For the individual companies?
Correct.
Yeah, I tend to focus on general, looking at an entire proxy group is usually how I focus than looking at individual results. You were pointing to a specific place in my testimony?
No, more just a general question to confirm that you don't show the CAPM result for any of the individual proxy companies in your analysis, correct?
No, you can see the betas for the individual companies, but I don't provide I'm not providing a cost of equity recommendation for individual companies.
Now, if you could please refer to Mr. Novak's rebuttal exhibit at YGS ROE rebuttal -8.
I'm there.
And here, Mr. Novak has extracted the option implied betas from your work papers, correct?
Yes.
And this lists the 7 companies in your proxy groups and the beta coefficients for each week for those 7 companies, correct?
Yes.
And for 3 of the companies in the proxy group, you interpolate the results, correct?
There are four of the 7 I do some type of interpolation. Is that what you're referring to? There's one company, at most, there's no interpolation needed, right? And there are 2 companies that I have no data for and 4 that have some type of interpolation that's needed across from week to week. Yeah.
And rather than interpolation, another option would be to exclude the values on dates where there was insufficient data, correct?
Yes, I think we'd be excluding valuable information to do that.
Have you employed that approach in prior proceedings?
Have I done any kind of interpolation?
Correct.
Yes. Yeah.
And you testified in the Aquarian Water Company rate case in Pura docket number 22-07-01, correct?
Yes.
And in that case, you did not interpolate or extrapolate any beta estimates from week to week for any proxy companies, correct?
I have to review. I mean, I would check. I would agree, subject to tech. That was something that I had been thinking about over time about how to make sure to get as much information from this data as possible. I mean, the idea of interpolation, the VIX index that Mr. Novak cites uses interpolation. Every single one of those data points is an interpolation. When you look at the U.S. Treasury Gov website and look at Treasury yields, they're all interpolated. So the idea of the use of interpolation is very common. It's pervasive, in fact. So I had been deciding that if we have this information, sufficient data to calculate option implied betas on 11/26, and we also have it on 12/10, I would, or looked into interpolating to basically use that information, and I find it's more, it would be throwing out information to exclude that data. And so that's why I chose to interpolate, as many other financial data providers have also chosen to interpolate.
And specific to my question, though, in docket 220701, you did not interpolate or extrapolate any beta estimates from week to week, correct?
I said I would agree, subject to check.
Now, in some cases like NiSource, which has the ticker number NI, the beta coefficient did not change for 8 weeks during your analysis, correct?
That's right.
And you excluded the other 6 weeks, correct?
Yes.
And that's because there was insufficient data and you just continued to use the same value each week, correct?
Yeah, I made a determination to not, to try to use as much information as possible, but not go too far in terms of making sure that, so in here, I had made a judgment call based on how much information is required. I understand, I think I need to have it clear, I have a clear way about determining when to interpolate, when to exclude. But the intention here is to make sure to include as much information as possible, but not too much. And there are statistical ways of measuring this, which we're in the have been doing. And what we're doing is proving to be statistically, I think, basically show that this is statistically viable to do it this way.
Now, there are 2 companies in your proxy group that do not have any option implied betas, and that's New Jersey Resources and Northwest Natural, correct?
That's right.
And 2 out of 7 total companies make up more than a quarter of your proxy group, correct?
For the forward betas, remember we have historical betas for them. So for it's a subset, right?
And just confirming my math, though, 2 out of the 7 is more than a quarter of the proxy group, correct?
For option implied betas, not for the historical betas, we have them.
For option implied betas, correct?
Yes.
And you didn't use these 2 companies in your option implied beta analysis because there wasn't option data available for these companies during the limited 14-week period that you used for the analysis, correct?
Yes, or there wasn't the option data didn't pass the screening criteria used by the CBOE.
And do you discuss in your testimony or analysis that 2 companies in your proxy group were not actually used in the calculation of the historical betas in your testimony?
I did not identify, there's a lot of information in here. I did not identify everything, but you can see in my work papers that these companies were eliminated. I believe I explained that I use the CBOE filtering technique and will not calculate options if they don't pass that screening criteria. So it's here in the work papers, it's transparent in terms of what I did, and that these were not, that I did not calculate them here.
And not something that was called out as part of the testimony, correct?
I did not describe that in the text, no.
Now, out of the 7 companies in the proxy group, you mentioned only 1 company had sufficient data for you to use without excluding them, interpolating or extrapolating data, correct?
That's right.
Can you please turn to your rebuttal testimony at page 31? That goes on to page 32. And there you discuss how, despite the fact that there are fewer stock options available for gas utility stocks, you stand by the value of these results because they are based on a direct measure of investors' forward-looking risk expectations, correct?
Yes.
Are the data points that you chose to interpolate, extrapolate, or exclude direct measures of investors' forward-looking behavior? Or are they instances where you exercise your judgment in how to address observations with insufficient data to calculate an option implied beta?
I stand by the use of interpolation. I think that I will, in my next testimony, explain that more thoroughly, and I've already done some detailed statistical tests on that I will describe in more detail, and I think that I will keep that for sure, because as I would not recommend that the U.S. Treasury Gov change their website so they don't do any kind of interpolation. No, I plan to continue to do that and provide additional statistical support for that.
So overall, there are 7 companies in the proxy group, and there's 14 weeks of data. So that would allow for 98 potential direct observations of beta, correct?
Yes.
And in Mr. Novak's rebuttal testimony that we had up, that exhibit YGS ROE Rebuttal 8, that shows there are only 31 actual observations that are not interpolated, extrapolated, or excluded, correct?
Yes, for the option implied betas.
And that's less than a third of the potential proxy group observations, correct?
For the option implied beta portion of the calculation, yeah.
And it would be a flaw in an analysis if you didn't have sufficient data to draw the conclusions that you've drawn, correct?
Can you repeat that?
Sure. So it would be a flaw in an analysis if you didn't have sufficient data to draw the conclusions that you've drawn, correct?
Yeah, I believe I have a tremendous amount of data to draw upon. That's why I go to adding stock options into this consideration. I think is adding a tremendous amount of information, as we had discussed before, showing the charts and just how much information options can provide. Again, Mr. Novak, it's funny, cited that really at the beginning of his testimony. It's something that's such an obviously helpful place to go. And to bring this here and to provide as much information as possible is what I'm doing, including doing some interpolation here to make sure that we can get as much information as possible. And again, as I had expressed, looking at the performance of option implied betas just over the recent months, again, it's interesting how there are forward measure of historical betas, which is just really showing there are an excellent source of information about the cost of equity.
And in your response, when you referred to stock options, were you referring to stock options generally, or were you referring to option implied betas?
Oh, stock options in general, I think, yeah, and including option implied betas.
Is there a minimum number of observations that you would require before presenting a proxy group average option implied beta?
I'm sorry, can you repeat that?
Sure. Is there a minimum number of observations that you would require before presenting a proxy group average options implied beta?
I'd have to think about that, but I think I believe that this is a sufficient amount of data to look at and be considered for option implied betas for gas utility stocks. I think for sure. Is there some kind of minimum? Well, the thing too is just that when you look at my analysis overall, it's not the only, it does not, my whole recommendations doesn't hinge on option implied beta. So even if there isn't as much as we'd like here for option implied betas, there's a lot of other information that comes in to make my ultimate recommendation.
You mentioned that the analysis doesn't hinge on option implied beta, but I think earlier in your testimony today, you called it the bedrock of your analysis. Is that correct?
Options are the bedrock. I mean, the bedrock of my analysis is looking into markets. If I would throw out options if there was something better. I wouldn't say option implied beta is the bedrock, but it's a very powerful one because it's relating directly options to the capital asset pricing world or the cost of equity. But I would say the bedrock is to go to capital markets and where I'm emphasizing right now are stock options.
So to confirm, to make sure I understand, the bedrock is not option implied beta?
No, I would say the bedrock is capital markets, looking to capital markets.
Now, would you agree that interpolating or extrapolating beta estimates would have the effect of smoothing observations on a week-to-week basis?
But interpolating smooth the data?
Yes.
Generally, it would, if it's a linear interpolation, so it's going to be generally certainly not going to, the way that I'm doing it, it's not going to cause additional volatility of the numbers, no.
So let's focus on the only company in the proxy group that actually had observations every week, which is Atmos Energy Company, excuse me, Atmos Energy Corp., correct?
Yes,
And to be clear, this is the only company that you were able to calculate an option implied beta for every week in the analysis, correct?
let's see. Yes, that's the only one that didn't require any interpolation. There were, yes.
So sticking with Mr. Novak's rebuttal exhibit YGS ROE rebuttal 8, that shows that the value for Atmos on December 24th, 2024 was 0.275, correct?
Yes,
And then about 2 weeks later, on January 7th, 2025, the value increased to 0.509, correct?
yes,
And then another 2 weeks later, on January 21st, 2025, the value went back down to 0.219, correct?
yes,
And that's a change in beta of more than 0.3 from January 7th to January 21st, correct?
yes,
And as Mr. Novak calculated in his exhibit YGS ROE rebuttal 8, based on your estimated risk premium of 3.79%, changes in beta of more than 0.3 suggests a change in the cost of equity of more than 100 basis points. Is that correct?
yes.
Have you researched and identified the cause that would have made investors in Atmos Energy change their return requirements by 100 basis points in a 2-week period at that time?
No, that's why we should, I wouldn't recommend calculating the cost of equity for individual companies. That's why it's good to have a proxy group, because the capital markets are noisy, and you can have, for individual companies, things can change. So that's why I would not set the cost of equity for Yankee just based on one company.
So the beta coefficient for Atmos on February 18th, 2025 is 0.105. And you can see that from that same rebuttal exhibit from Mr. Novak, correct?
Which date?
February 18th.
Yes, 0.105.
And do you see below that Mr. Novak applied your risk-free rate of 4.33% and your market risk premium of 3.79% to determine the CAPM result for this estimate of beta?
In the table right below that,
Correct.
where it shows a cost of equity of 6.36 on 218?
Correct.
Yes, I see that.
Do you agree that with your risk-free rate assumption and the market risk premium assumption, this beta estimate of 0.105 yields a CAPM result of 4.73%?
Yes, I would not recommend a cost of equity of that number.
Do you recall earlier when we discussed the yield on the 30-year Treasury bond?
Yes,
Do you recall that we agreed that the yield on the 30-year Treasury bond has been consistently 4.7% or higher over the past month?
yes.
So going back to your response just a moment ago, do you believe that 4.73% is a reasonable estimate of the cost of equity for a utility company?
Yeah, but I'm not recommending that. That's why I provide a lot of comprehensive data. And I think that to go in and which has happened to me many times, to go in and pick through thousands of pages of spreadsheets and find one or two numbers that are like this is kind of interesting, right? I mean, I would not recommend that. You have to look at a comprehensive amount of data. As I've said, if you really step back, if you don't take one individual company or one individual date and you step back, it's quite amazing about how clear it is that this is providing valuable information. And I want to step back because I did see that it's in here in my rebuttal testimony, where I show on page 30 of my rebuttal testimony. And look, if they're wondering there, looking in, picking one date for one company to try to find something that could be astray, if you want to step back and take a big picture and ask, can option data provide valuable information about the cost of equity? Look to that chart, on chart 3 on page 30 of my rebuttal testimony, that shows on the big picture what happened to historical betas, option implied betas during COVID, and what happened after. And you can see there's a yellow line in there that shows that the option implied betas came down and then the historical betas followed suit. So when you step back on a big picture and don't get in the weeds and find some little piece, you'll see provides valuable information about determining the cost of equity.
And to be clear, you did not exclude the data point that we were talking about, correct? You just averaged it with the others.
I did. I included that. I didn't exclude any on the high side either. There were some of the companies had betas that were over 1. It was OGS had a beta of slightly over 1. I didn't exclude that either.
Now, you talk about the amount of information, and you provided more than hundreds of work papers to support your cost of equity estimates in this case, correct?
That's right.
And many of these work papers support your beta calculations too, correct?
That's right.
And for both your historical betas and your forward betas, you do not rely on beta coefficients published by any one source. Is that right?
No, I calculate them myself.
So while the historical betas may replicate processes employed by other sources, these are numbers that you calculated yourself, and they're not specific estimates that can be matched to another independent source, correct?
No. Because if I just went with the value line, they could be out of date. Somebody takes 3 months. So even if we pretended the value line was an accurate source for betas right now, the 5-year historical betas, you still have to wait 3 months many times for the value line pages to come out. So I think it's valuable to be able to calculate them so we can be more accurate and more up to date.
Now, can you please turn back to Exhibit ALR 4? And specifically at page 3. Are the work papers the only place that the beta coefficients in this Exhibit ALR 4, page 3, can be validated?
Are the work papers the only place that you can validate these?
Correct.
Yeah, that's how they could be validated, is to look these, go through the work papers and see the calculations, and also you could read my testimony to see, because I provide the white papers from the CBOE, how I do the filtering and everything. So yes, from the work papers and reading my testimony, you should be able to validate these numbers, yes.
Just 1 second, please. Thank you. Now, in your rebuttal testimony, if you can please turn to page 3. You mentioned this a bit earlier with the OCC's questioning, but you claim in your rebuttal testimony that there is an inconsistency with S&P commentary between the December 2024 report accompanying the credit rating downgrade and S&P Global's January 2025 industry credit outlook, correct?
What line number?
I'm sorry. It starts in the middle of the page, line 8, and then it goes on to the next page through line 4
Oh, this is page 3 of the
of the rebuttal
of the
testimony.
servo, yeah. Line 3. Is that the page that shows the chart 1, the bond yield comparison?
Yes, there's a chart 1. So the discussion I'm referring to starts on page 3, line 8,
I
and
see.
it goes on to page 4, line 4, 5, 6, basically.
Okay, where it says the real-time market evidence aligns with S&P Global's January 2025 industry credit outlook, which described Connecticut's regulatory construct as credit supportive. You're asking me about that?
I don't think that's the quote, unless I'm misreading it right now. Oh, yes, I was looking at the bottom of the page. So yes, it starts there.
And then it says investors' actual behavior in the bond market supports this conclusion, not the speculative assertions advanced by Mr. Novak and Dr. Michael.
Correct.
Okay.
And then the specific question that I had asked is a little bit lower. It's below the table, or the
Okay.
chart, I should say. And that's where it states, moreover, to underscore the inconsistency in S&P's own commentary, it is important to note that the same rating agency that downgraded Yankee Gas in December 2024 claimed just 1 month later in January 2025 that Connecticut's regulatory construct is, quote, credit supportive.
Mhm.
This contradiction raises questions about the reliability of selectively quoting from S&P's credit reports without acknowledging the full context. That's the focus of my question. Is that all correct there?
Yes.
Now, did you produce a copy of these materials into the record in this case?
Of the calculations for chart 1?
The S&P articles and reports that you were quoting from December 2024 and January 2025.
I don't recall if we did or not.
With the chair's permission, I have a copy of the January 14, 2025 S&P Global Ratings Industry Credit Outlook that Mr. Rothschild cites to and relies on in his rebuttal testimony. May I present this to Mr. Rothschild?
Any objection?
I have maybe 1 or 2 copies, but we're also happy to either introduce copies in the record. I was going to ask a question down the line if we could enter this as a late file, if Mr. Rothschild would enter this as a late file exhibit.
Okay, 1 moment.
Just a moment. Thank you. Oh, we can handle this.
Okay, um, I know we had a similar issue come up earlier in the hearings with a company witness, who didn't have access to a manual, and we had asked that to be provided as a late file. So for consistency, I would, say that if this isn't in the record, we can ask the EOE to, provide it as a late file and ask questions about it at the late file exhibit. And, since that's the treatment we afforded the company earlier in the, proceeding, unless EOE is prepared to move forward right now.
I think that would make sense. What I'd like to confirm is that this is the specific document that Mr. Rothschild referred to in his testimony. So that's from, I guess that's the first question, and that I don't know.
Okay, is the company making the request that Mr. Rothschild provide this as a late file exhibit into the record?
So to answer that, yes, the company is. I'm also happy to begin asking questions about it, given that this is something that Mr. Rothschild cites to in his testimony. And I can, in fact, ask the very question that Mr. Lopez asked about, is this the same document? And then based on Mr. Rothschild's review, I could continue to ask questions about that document as it pertains to his rebuttal testimony.
Take care of one issue at a time. This will be the late file exhibit 34 will be, 134 will be directed to EOE, and it is for Mr. Rothschild to provide a copy of whatever underlying work paper is cited in his testimony regarding S&P Global's industry credit outlook. And then defer to Director Lopez, if you want to be heard on the question of asking questions on this now or at the late file exhibit hearing.
We'd prefer to be heard at the late file exhibit hearing. However, the one thing I guess I would just want to confirm here, and then we could continue at the late file exhibit hearing, would be to a confirmation that this is in fact what Mr. Rothschild cited to. I don't know if it's another S&P credit out. I just don't know. So I'm just trying to figure that out as well.
Okay.
And that's why I would prefer moving forward at a late, like beyond that, I'd still prefer moving forward at a late file exhibit hearing, just to be generally prepared. But
and if I may respond to that briefly, please. So first of all, this is, if Mr. Rothschild confirms that it is in fact the same document, it's referenced in the rebuttal testimony as a source of one of his arguments in the rebuttal testimony, but it also came up earlier in the OCC's examination of Mr. Rothschild, and he used terms that come specifically from the document. So some of my questions are also responding to the testimony from earlier today. So I certainly understand that if it's a late file exhibit, it would be something that's appropriate for the late file hearing. What I'm asking is if there's a way to ask questions that discuss the his testimony as it references that document from both his rebuttal and from his oral testimony earlier today. Could I try to explore it, and then we can be happy to revisit it at the late file if necessary?
Sure.
I think that's fine if I'll just retain the right to object to questions as they come.
Okay, then we can proceed with that caveat.
Thank you. Mr. Rothschild, is the document that we put before you that we've been discussing for the last few minutes the same document that's referred to on page 3 of your rebuttal testimony, referred to as S&P Global's January 2025 Industry Credit Outlook, which described Connecticut's regulatory construct as, quote, credit supportive?
Just checking one thing. Yes, I'm pretty sure it is. It looks, everything checks out, so I don't know how it's to be agreed subject to check through the process. So, yeah.
Thank you. Did you review S&P Global's January 2025 Industry Credit Outlook prior to quoting it in your rebuttal testimony?
Did I read it prior to quoting it?
Yes.
I don't remember the exact date I first saw it, but I do remember. I certainly had read it before I filed the testimony, yes.
Are you familiar with the rating scale that S&P uses for all states?
Please continue in terms of, I believe I do know what you're referring to.
If you could please turn to page 8 of that document. Are you there, Mr. Rothschild?
Yes.
And you're citing from your rebuttal testimony is referring to page 8, and I'll direct you to the statement that says, quote, "We assess all North America's regulatory jurisdictions as credit supportive or better, reflecting the industry's generally stable and predictable cash flows," correct?
Yes.
And is it true that the ratings are as follows? Number 1, most credit supportive. Number 2, highly credit supportive, followed by very credit supportive, more credit supportive, and then the last category is credit supportive?
Yes.
So credit supportive is the lowest rating given by the S&P, correct?
It still just says credit supportive.
And of the chart, credit supportive is the lowest rating given by S&P.
Yes, and it says credit supportive, which is among the list you just read, yeah.
And understood what it says, but I read from page 8 that all assessments are credit supportive or better. So therefore, by reading the list, credit supportive is the lowest rating on that list, correct?
Yeah, it's credit supportive. It certainly does not say junk bond.
Sure, and I didn't ask about junk bond, but the lowest rating on the list you agree with.
It's the lowest rating on this list, yes.
And are you aware that Connecticut and one other state, which is New Mexico, are rated that lowest rating?
Is it, it says there on that page that New Mexico is also rated the same?
And maybe I'll apologize, Mr. Rothschild. There's typically there's a color copy. Is this a black and white or a color?
I have color.
Thank you.
All right.
So if you follow along the list that I read, most credit supportive, highly credit supportive, et cetera, all the way down to credit supportive, there's a color box next to the ranking, correct?
Yes.
And the only two states in the map that have the same color box as credit supportive are Connecticut and New Mexico, correct?
It's a little hard to tell about Rhode Island there, but I'll trust you. If that's not red as well, I cannot tell.
If you'll accept subject to check.
Okay. Then it appears there's only two that are red, yes.
Now, S&P Global's January 2025 industry credit outlook that we're looking at here is an industry overview and provides a discussion of only a limited number of jurisdictions within it, correct?
It describes only a limited number of jurisdictions. That's what it says.
I guess I'm maybe going to start objecting to this line of questioning. I mean, this is not specifically Mr. Rothschild's testimony. If we are going to be then admitting it at a late file exhibit hearing, I think the most appropriate place for cross-examination continuing on this exhibit would probably be the late file exhibit hearing when that's admitted.
Attorney Hum, do you want to be heard on the objection?
I have only one or two more questions on this document, specific to this document. And one is simply reading certain text from the document. And then it goes right back to Mr. Rothschild's rebuttal testimony, which compares this document to a document that is in the record. And that's the December 2024 report.
Okay, so I just want to make sure I understand. You want him to read text from this into the record? You want him to read text from this exhibit into the record? That's your next question.
It's to confirm certain text with respect to what this document discusses. And by doing so, yes, I'll be asking them to confirm certain language into the record.
Okay. I'm just a little confused because this document's not in the record yet. So
it does, and just at a quick look, it does look like there's a link to this article in Mr. Novak's testimony at page 79 of his rebuttal testimony. So I'm not sure then we would be required to admit this as a late file exhibit. So it's already cited and linked in Mr. Novak's testimony. So seeing that, this seems generally inappropriate for continued cross-examination for Mr. Rothschild. And given the fact that the company's cost of capital panel is coming back for redirect testimony, I don't know. It's up for review already in the record, so I'm not sure where this is going. And again, this, while it was cited by Mr. Rothschild, the article itself was not presented by Mr. Rothschild.
okay,
If I may have just a moment to respond, Madam Chair.
sure, Attorney Hum.
Thank you. Just first of all, to distinguish between a link and a document in the record, a link is a helpful source. It's not always deemed a document in the record. So that would be the difference here in the request for this document to be in the record. That's the first point. And then the second is even understanding that the document itself may come into the record as a late file exhibit. We are here examining Mr. Rothschild as part of his rebuttal testimony, and this document could also be used for impeachment purposes with respect to testimony that he's given in his rebuttal testimony versus what this document says. And he did testify that he reviewed the document as part of putting together his testimony.
Okay, I appreciate that, Attorney Hum. Those things can also be done at the late file exhibit hearing. So I am going to resolve this by keeping it as a late file exhibit hearing, late file exhibit directed to EOE, and I had previously marked it as 134. And I think we've taken those questions as far as I'm prepared to allow them to go this afternoon until the document has been admitted into the record. So we can pick up with those questions at the late file exhibit hearing.
Thank you. And if I may have one moment, that might conclude our questioning.
Please.
No further questioning. Thank you.
Thank you. Authority staff, Attorney General. Thank you, Commissioner Karen.
No questions.
I did not have any questions for this witness either. So Director Lopez, Attorney Sahi, do you need a moment to consider redirect?
Yes, may we have 5 minutes to consider redirect?
Yes, we'll recess for 5 minutes.
Thank you.
Director Lopez.
Yes, thank you, Madam Chair. We do not have any redirect for our witness.
Okay, thank you. This witness is excused, which leads us into recalling the company's three witnesses that Attorney Pace delineated earlier from the cost of capital panel, please.
Thank you. And that would be Mr. Horton, Ms. O'Neill, and Mr. Kalin.
Thank you. Okay, Attorney Pace.
Thank you, Chairman. And again, consistent with my representation during the argument I made, I'll limit it to the very specific issue of equivalence between capital structure at the parent and subsidiary. Ms. O'Neill, do you recall the exchange earlier today between Attorney Wheel and Mr. Rothschild regarding the capital structure for Yankee Gas and its corporate parent Eversource?
I do.
Do you recall he suggested that the capital structure of Yankee should be equivalent to the capital structure of its parent Eversource?
I do.
Do you agree with this recommendation?
I absolutely do not.
Could you please elaborate on your conclusion as to why you disagree?
It's not appropriate for the Yankee Gas capital structure to be the same as the Eversource capital structure. Yankee Gas is a regulated gas company, while Eversource is a holding company whose capital structure includes stock issuances, unregulated write-offs, and rate reduction bonds, none of which relate to Yankee Gas's capital structure. Yankee Gas issues debt on its own and has its own credit ratings. The rating agencies expect the equity ratio at Yankee Gas to be approximately 54%. I would like to refer you to RRU 69, attachment 2, page 29.
And could you please identify for the record what piece of information in that document you'd like to call to the authority's attention?
I will. Under liquidity analysis on page 29 of attachment 2, Moody's states, we expect Yankee Gas to maintain sufficient liquidity profile primarily due to its stable cash flows and its access to its parent's joint revolving credit facility. In addition, we expect that Yankee Gas's dividend policy, parent equity contributions, and any long-term debt issuances will be managed in a manner to maintain the utility's regulated capital structure, including an equity ratio of almost 54%.
Thank you, Ms. O'Neill. And Mr. Kalin, you were also here in the audience during that exchange between Attorney Wheel and Mr. Rothschild. Do you have any additional explanation as to why it's not reasonable to expect the capital structure for Yankee Gas to be the same as that of its corporate parent Eversource?
I would just offer a simple example. If the Public Service Company of New Hampshire, which is an Eversource subsidiary, issued long-term debt, it would influence the Eversource consolidated equity ratio, or what you may hear as the equity ratio at the holding company. But because this debt would be in support of New Hampshire operations, New Hampshire assets, perhaps to fund recent storms, for example, Connecticut customers should not have to pay for that debt. Therefore, it's not appropriate that you'd include that debt in Yankee Gas's capital structure or that of any other subsidiary for that matter. I'd also add that Yankee Gas's credit ratings are based on its own credit metrics, which are based on its own financial statements, its own balance sheet, its own level of debt, not that of the holding company.
Thank you. That completes my examination of this panel, and Chairman, they're available for cross-examination by other parties. Thank you.
Thank you. So I will poll the other parties and see if they wish to recross EOE. Okay, thank you. Authority staff. OCC. Attorney General.
No.
Me neither. Thank you. I do not have questions either. Okay. I'll look to the company to confirm that we have completed the company's evidentiary hearing presentation.
We have completed our evidentiary presentation except for the late file exhibits. What I would request would be under administrative matters, since we've completed 8 days of hearing, do we have latitude to allow the company president to briefly express his appreciation to the authority and also to parties for their work over the past 8 days before we close, if that's acceptable to the chairman?
Joy, I don't see why not. I'll just remind Mr. Kelly that he's under oath, remains under oath. He's welcome to approach. A microphone, please.
Mr. Kelly, you can approach the mic at the table or at the podium. Provide your brief comment.
Hello? Can you hear me? Can you hear me now? Okay, great. Thank you. I just wanted to take a minute to thank you, Chairman Gillette and Commissioners Karen and Aconti, for all your time and guidance through this process. And thank you for this opportunity for this hearing to allow the company to present important information. I also want to thank the Pura staff, EOE, and OCC, and other parties for their participation, level of detail, and professionalism throughout the rate case hearing. I also just wanted to say thank you to the Eversource employees and our legal staff for many hours of preparation for this case, and several employees participated throughout the company. And again, just wanted to take a minute and thank you for that.
Thank you, Mr. Kelly. I will now turn and poll the parties for administrative matters. I'll start with the company.
Chair, we have no administrative matters regarding the scheduling or late files. It's all very clear. Thank you.
Thank you. Any other party or intervener with an administrative matter? If not, I believe we have completed our read-ins and we have 134 late file exhibits. So we will look for those to be filed on June 18th. And then we will see everyone here on June 26th for the start of our late file exhibit hearings. I do want to flag, make sure folks notice that it starts at 9 a.m. for the late file exhibit hearings. That is not a typo. So we will see everyone here at 9 a.m. on June 26th. With that, we are adjourned. We'll issue a cancellation notice for tomorrow and Wednesday's hearing dates. Thank you.